Very good morning, everybody. Okay, so yesterday we completed section 10 AA and two practical questions on section 10 AA. And we also started with some other sections with respect to exemptions. So today we need to complete this exemption section. Section 10 clause 2A is over. Section 10 clause 2A is over. Section 10 clause 2, clause 2A, section 10 clause 4, clause 6, subclause 2. So that is point number 5. Up to point number 5 is over, right? Up to point number 5 is over. Point number 6. Salary received by a non-citizen, non-resident for services rendered in connection with employment in a foreign ship. So if some foreign ship is coming to India, on that foreign ship, there might be a foreign crew member. There might be a foreign crew member. Whatever salary is received by them while that ship is coming to India, for those many number of days for which the ship is in India, for those many number of days, whatever salary is received by them is not taxable, is exempt from tax provided total stay in India does not exceed 90 days in the previous year. Provided total stay in India does not exceed 90 days in the previous year. See, all these sections are not relevant for the examination. Frankly speaking, I am teaching for the first time to any batch. Otherwise, I have never discussed these sections. Point number 7, remuneration received by foreign government employee during their stay in India for specified training. For example, India and Russia is the military forces of India and Russia are jointly learning something. They are doing some joint operations. For that, foreign government employees are in India for their training. In that case, during that training period, whatever income they have earned, remuneration definitely received from foreign government only, that will be exempt from tax, provided there is an agreement between such foreign government and Indian government, or foreign government and company wholly owned by central government, state government, or foreign government and company which is a subsidiary of central government and state government companies, or it is a statutory corporation or society registered under the Societies Registration Act. So in simple language, we can say that whatever remuneration is earned by an employee who is a foreign government employee, he has come to India for the purpose of training. So whatever remuneration he has earned, that will be totally exempt from tax. Education scholarship. Scholarship is nothing but amount given to you for meeting the cost of education. Scholarship is generally granted to meet the cost of education. So whatever scholarship you receive will be totally exempt from tax in section 10 clause 16. Here, how many sections are important? Na? I'll tell you how many are important. Point number 1, 2, 3. You can mark this in your book. You can mark this in your book. Point number 1, 2, 3 are important. Point number 8, 9, 11. Point number 8, 9, 11. That's all. Point number 9 says any award or any reward received either from central government or from state government or from any institution which are approved by the central government or state government. Either you have received any award or you have received any reward from whom? From the central government, state government, or any institution which is approved by the central government or state government, those awards will be exempted from tax. Tax will not be levied on those awards. So this was point number 9. Next we have point number 10. Income of the member of scheduled tribe. A member of scheduled tribe residing in any area specified in the constitution, like North Chachar Hills district, Krabi Anglong district, Bodoland territorial areas district, Khasi Hill district, all these areas are specified. If the income of member of scheduled tribe is earning any income from these areas, from any source in the area mentioned here, then that income will not be taxable, that will be exempt from tax. So income earned by whom? Income earned by scheduled tribe. From where? From the specified areas will be exempt from tax. Or dividend income, interest income earned by them will also be exempt from tax. So basically, they are talking about two incomes. Income earned from specified area, any income in that specified area, any income, and income earned in the form of dividend and interest. These two things will be totally exempt from tax. See, these areas now, anyway, you have less opportunities for earning the income. Economic activities are very low in these areas. Very less economic activities. And government wants to ensure that these people stay there only. They create some employment opportunities there only. So government says your income will be exempt from tax. Point number 11. Income earned by Sikkimese individual. A person who is from a Sikkim and his name is mentioned in the records maintained by the state government, that person will be called as a Sikkimese individual. Any income earned by Sikkimese individual from any source in the state of Sikkim will be exempt from tax. Any income earned by Sikkimese individual from any source in the state of Sikkim will be exempt from tax. Besides that, dividend and interest income will be totally exempt from tax. However, exemption will not be available to a Sikkimese woman on or after 1st April 2008 if that Sikkimese woman has married to non-Sikkimese individual. So, if Sikkimese girl, a girl from Sikkim, a Sikkimese girl, if she gets married to non-Sikkimese individual, then she will lose the exemption in section 10 clause 26 AAA. If a non-Sikkimese girl marries a Sikkimese individual, then what? Then that girl will not become a Sikkimese girl. Sikkimese person means whose himself, his own name or the name of his parents or grandparents, etc., is recorded in the records maintained by the state of Sikkim. Have you understood this? This point number 10 and 11, they are on the same lines. Simply they are saying that any income earned from that particular area will be exempted, and besides that, interest income, dividend income will also be exempted. So if they have kept a fixed deposit and they are earning interest from that, that will be totally exempt from tax. Not FD, but interest on securities. They have invested money in debentures, bonds, etc., or government securities, then whatever interest they earn on those securities will be exempted from tax. FD interest will be taxable. Point number 12. Point number 13. They are going on in the same lines. What it says? You have received a subsidy from a T board. See, for taking the examination, there is a state board now. For taking 10th standard examination, there is 12th standard examination. You have a board now. Education board. Similarly, here there is a T board. What is the job of T board? Job of T board is to promote the manufacture, promote the tea agriculture, promote agricultural activities relating to tea. See, in tea business, when you grow tea leaves, there is something called as tea bushes. You have to dig the land and you have to put tea bushes inside that. The way you are planting now, similarly you have to put tea bushes. The productivity of tea bushes is for around 2 to 3 years. After 3 years, once again you have to do the digging. You have to remove the old tea bushes and put the new tea bushes. For this purpose, they may receive subsidy from the government. Government is providing subsidy for replacement of tea bushes. So whatever subsidy is received for replacement of tea bushes from the government through the tea board will be exempt from tax. So any amount of subsidy received by SSC engaged in growing and manufacturing tea in India or from tea board will be totally exempt from tax, provided certain conditions are fulfilled. Subsidy should be received for replantation or replacement of bushes or rejuvenation or consolidation of areas used for cultivation of tea. So basically, you can remember for replacement of tea bushes, if you have received any subsidy, that will not be taxable. Provided you have to submit a certificate from the tea board along with the income tax return. You have to get the certificate from the tea board saying that this much amount of subsidy was received. Sorry. So if these two conditions are fulfilled, subsidy will be exempt from tax. Other subsidies. Dikshit, you are asking me meaning of rejuvenation? Sarvan is asking, so only rejuvenation means to reinstate the productivity. Rejuvenate means to reinstate the productivity. Sarvana, this subsidy will be totally exempted from tax. No tax on it. That bifurcation into 40%, 60%, that will not be required. This subsidy will be totally exempted because this subsidy is received clearly in connection with agricultural activities only. For removing the old tea bushes and planting the new tea bushes. So subsidy is received in relation to agricultural activities only. It is not received in connection with non-agriculture activities. Other subsidies. Subsidy received by SSC engaged in the business of growing and manufacturing rubber, coffee, cardamom, or other specified commodity in India will be exempt, provided subsidy is received for specified purpose. What do you mean by specified purpose? Rejuvenation or consolidation of areas used for cultivation of such commodities. Certificate should be received from prescribed authority. That is, from the board, you should receive the certificate. Then your subsidy will be exempted. This point number 14 now, you remove this point. This section is deleted. Up to last year, company used to pay dividend distribution tax, and dividend earned by individual shareholder was exempted. Similarly, mutual fund used to pay income distribution tax, and income earned by the unit holder was exempted in section 10 clause 35. So now this section is no more existing. So remove this. This is not relevant. So list of exemption is over. Now we are left with one section, section 14A. This is the last section of this chapter. Restriction on allowability of expenditure. Now listen to me very carefully. Before we actually move on to this section, I need to provide you some background. See, if any income is taxable, then you can claim deduction for any expenditure incurred for earning the income. For example, whatever income I am earning by taking the lectures, that is taxable. So I can claim deduction for any expenditure incurred for earning the income. For example, I have incurred a traveling expenditure. I have incurred internet connection expense, depreciation for laptop, other expenses. So all those incomes which are taxable, for earning those incomes, if you have incurred some expenditure, those expenditure can be claimed as deduction while computing the income. On the other hand, if the income is exempt from tax, then any expenditure incurred for earning that income cannot be claimed as deduction. Income is exempt means government is not levying tax on that income. If government is not levying tax on income, why should government give you deduction for the expense? Say for example, your income is 100 and your expenditure is 60. So your net income is 40. Government says on this net income of 40, we are not levying any tax. So whatever expenditure you have incurred 60, that cannot be claimed as deduction. So if the income is taxable, expenditure incurred for earning the income can be claimed as deduction. On the other hand, if the income is exempt, then expenditure incurred for earning the exempt income cannot be claimed as deduction. Now, you just imagine the profit and loss account. In the profit and loss account, on the credit side, you might have some income which is exempt from tax. In the profit and loss account, credit side, you might be having some income which is exempt from tax. So, on the debit side of profit and loss account, On the credit side, if you are having some income which is exempt from tax, then on the debit side, in profit and loss account debit side, you are having a lot of expenditure. In that expenditure, you have to identify which are the expenses which are specifically incurred for earning that exempt income. You have to identify those expenditure which are appearing on the profit and loss account debit side, and they are exclusively incurred for earning the exempt income. So from the profit and loss account credit side, that exempt income will be removed, on that tax will not be levied. Similarly, from the profit and loss account debit side, any expenditure which is appearing on the profit and loss account debit side, and that expenditure is incurred for earning the exempt income. That expenditure is incurred for earning the exempt income. That expenditure should also be disallowed. Since income is not taxed, expenditure cannot be claimed as deduction. Have you understood this much? Yes or no? Yes. So, any income which is exempt from tax and is appearing on the profit and loss account credit side, that is not taxable. So you have to remove that income while you calculate your total income, that is required to be excluded. Similarly, any expenditure which is appearing on the debit side of profit and loss account and it is specifically incurred for earning the exempt income, that expenditure should also be disallowed because the corresponding income is not being taxed. Besides that, you may incur a lot of expenditure which is a common expenditure. For example, in your profit and loss account credit side, you are having an income of say 10 lakhs. In profit and loss account credit side, you are having an income of 10 lakhs. Out of those 10 lakhs, now 2 lakhs is an exempt income. 2 lakhs is an exempt income. Now from the debit side of profit and loss account, you have to identify two things. Number one, expenditure specifically incurred to earn that 2 lakh rupees. Expenditure specifically incurred for earning that 2 lakh rupees. That you have to identify. That is called as specific expenditure, which is exclusively incurred for earning that income only, which is an exempt from tax. And number two, you have to identify common expenditure. Common expenditure means expenditure which is incurred for earning exempt income as well as taxable income. But we do not know to what extent expenditure is incurred for earning exempt income and to what extent expenditure is incurred for earning taxable income. So government says in your profit and loss account debit side, you have a lot of common expenditure. That common expenditure in costing you call it as overhead, na? That common expenditure in costing you call it as overheads. So here also there might be a lot of common expenditure. That common expenditure is incurred for earning a taxable income as well as for earning exempt income. Now the question is, whatever common expenditure, the proportion of the common expenditure which is incurred for earning the exempt income, that proportion of the common expenditure should be disallowed. It should be disallowed. But you have to identify now what is the amount of expenditure which is incurred for earning exempt income out of the total common expenditure. So it is difficult to identify. So government says we have made the rules. Government says we have made the rules. You simply follow the rules. You apply the formula which we will tell you. By applying the formula, you will derive one amount. That amount will be considered as an expenditure incurred for earning the exempt income, and that expenditure will not be allowed as deduction. That expenditure will not be allowed as deduction. Is that very, very clear? Have you understood the background? Yes, okay. So let us read this provision. Section 14A. Restriction on allowability of expenditure. Restriction on allowability of expenditure means expenditure which is incurred for earning the exempt income will not be allowed as deduction. First point is expenditure incurred for earning exempt income. This is not allowed as deduction. That is written in section 14A subsection 1. Section 14A subsection 2 says that assessing officer will determine the expenditure to be disallowed. Some expenditure is required to be disallowed because in your profit and loss account credit side, you are having an income. In the profit and loss account credit side, you are having an income which is exempt from tax. So from the debit side, you have to disallow certain expenditure. Now, how much expenditure should be disallowed? That will be decided by the assessing officer. And he has to apply, he don't have to apply his mind. Government has already made the formula. Government has already made the formula. Here, he has to just apply the formula. He has to just apply the formula. See, this is the formula he has to apply, and he has to find out certain amount. That amount will be disallowed. Expenditure disallowed will be determined by the assessing officer in two circumstances. Formula is given in point number D, and circumstances under which income tax officer has to apply the formula, those circumstances are given in point number C. Point number C says that assessing officer is not satisfied with the correctness of the claim of the assessor. For example, assessing officer, assessee claims that I have incurred only 10,000 rupees for earning the exempt income. On the credit side, you are having 10 lakh rupees. Out of 10 lakh, 2 lakh is exempt income. And SSC is claiming that I have incurred an expenditure of only 10,000 for earning this exempt income. In that case, income tax officer says that I am not satisfied with your claim. On the debit side, you are having huge expenses, and out of that, you are saying that only 10,000 rupees is incurred for earning the exempt income. How it is possible? So, assessing officer is not satisfied with the claim of the SSC, or SSC claims that he has not incurred any expenditure at all. He has not incurred any expenditure for earning the exempt income. That is what he is claiming. So there are two circumstances. Number one, if SSC claims that he has not incurred any expenditure, or he claims that yes, he has incurred certain expenditure, but income tax officer, assessing officer is not satisfied with the claim of the SSC, then the income tax officer will ascertain the amount of expenditure which is incurred for earning an exempt income, and that amount of expenditure is required to be ascertained by applying the provisions of Rule 8. Government has already made rule number 8. Assessing officer has to just apply that rule. Then he has to calculate the expenditure. Whatever expenditure amount is arrived by applying this rule, that expenditure will be disallowed. Since the income is exempt from tax, that expenditure will be disallowed. The expenditure incurred in relation to exempt income shall be aggregate of point number 1 and 2. Shall be aggregate of point number 1 and 2. Point number one is amount of expenditure directly relating to exempt income. That's what I told you. You have to identify specific expenditure. You have to identify the expenditure which is specifically incurred for earning that exempt income. That you have to identify separately. Then you have common expenditure. Now, out of common expenditure means that expenditure which is incurred for earning exempt income as well as taxable income. Out of common expenditure, how much portion is incurred for earning the exempt income, that is not known to you now. So government says you do one thing. For that common expenditure, you take 1% of annual average of monthly average of opening and closing balances of value of investment. So what you have to do? On a monthly basis, you take the opening value of investment, closing value of investment. Means value of investment at the beginning of the month and value of investment at the end of the month. Then you find out the average. How will you get the average? Opening value of investment plus closing value of investment divided by 2. So you'll get this average. So this is nothing but a monthly average. So how many amounts you will get? You will get 12 amounts. You will get 12 different amounts. So we'll have monthly average. You will have 12 different amounts month-wise. Then you find out the average of those averages. For that, what you have to do? You have to take all the monthly average. You will be having 12 amounts. So add up all those monthly average amounts and divide it by 12. You will get the average of monthly average. So we can simply call this as annual average of monthly average. Of that average value of investment, you take 1%. You take how much? 1%. That amount will be deemed to have been incurred for earning the exempt income. So you have to do two things. Number one, you have to identify from the profit loss account debit side, you have to identify which is the expenditure which is specifically incurred for earning the exempt income. That you have to take in point number one. Point number two, for common expenditure, whatever actual expenditure might have been incurred, common expenditure, it is difficult to find out the proportionate amount from common expenditure. So for common expenditure, we will take 1% of annual average of monthly average of opening and closing balance of value of investment. Then you add point number one and point number two. You will get the amount of expenditure which is incurred in relation to exempt income. That expenditure should be disallowed. Yes, have you understood this calculation? In 2014, CBT has issued some circular number 2005, circular number 5 of 2015. Sorry, 5 of 2014. What it says, CBT has clarified that the legislative intent is to allow only that expenditure which is relatable to earning of income. In other words, we can give you deduction for the expenditure only if that expenditure is incurred in relation to taxable income. If your income is exempt from tax, then expenditure incurred for earning exempt income should not be allowed. It should be disallowed. Therefore, it follows that expenses which are relatable to earning the exempt income have to be considered for disallowance, irrespective of fact whether such income has been earned during the financial year or not. Dikshit, aggregate of 1 and 2 will be disallowed. Aggregate of 1 and 2, this will be disallowed. This will be disallowed because this is an expenditure incurred in relation to exempt income. Let me give you a hypothetical example. Right now in this year, this example is not valid. Up to last year, this example was valid. For example, you have earned a dividend income. You have earned what? You have earned dividend income. You know that up to last year, dividend income was exempt from tax in the hands of shareholder. So dividend income is appearing on the credit side of profit and loss account. While you calculate your total income or while you calculate your business income, what you will do about the dividend income? Whatever dividend income is appearing on the credit side of profit and loss account will deduct now, because that is exempt from tax. Since we are removing the income from the credit side, from the debit side also we should remove some expenses which are incurred in connection with that dividend income. So government says you identify two things. Number one, expenditure which is exclusively incurred for earning the dividend income. Expenditure which is exclusively incurred for earning the dividend income. For example, for investing money in shares, you might have taken some small amount of loan. For investing money in shares, you might have taken some small amount of loan. So you might be having an interest expense. You might have incurred some expenditure as collection charges for collecting dividend. You might have paid collection charges to the bank. So all these expenditure are specifically incurred for earning the dividend income. Besides that, you might have incurred some common expenditure like for purchasing shares. You called up your broker saying that I want to purchase that 1,000 shares of Reliance. Kindly place an order. So broker will place an order. In the evening, you will once again call him saying that whether you purchase my shares or not. So he says that yes, shares are purchased. So this call, telephone expense which was incurred for making these two calls, this expenditure was incurred for purchasing the shares. From those shares you want dividend income. That dividend income is exempt. So this telephone expenditure for making these two calls should also be disallowed. But is it practically possible for you to find out all such expenditure? Is it possible practically for you to find out how much amount is incurred for earning the exempt income? No, it is not possible to trace. It is not possible to trace. So government says for those common expenditure now, you are receiving the telephone bill. In the telephone bill, you cannot identify how much telephone expenses were incurred for earning the exempt income and how much telephone expenses were incurred for earning the taxable income. It is not possible to identify. So government says you take 1% of the annual average of monthly average of opening and closing balance of the value of investment. For common expenditure, you take this much. And for expenditure which is specifically incurred for earning the exempt income, that you put it in point number 1. Then you add point number 1 and 2. Whatever amount is arrived, that amount will be disallowed to you because that amount of expenditure is incurred in relation to exempt income. Is that very, very clear? Yes or no? Now, why I gave you the example of dividend income, that you will understand in point number E. See, when you invest money in shares, it is not necessary that you will get dividend. If you invest money in shares, it is not necessary that you will get dividend. Say for example, in one particular year, you have not received any dividend because company has not declared any dividend. In that case, lot of people were claiming that I don't have the exempt income. I don't have the exempt income at all. So you don't apply this section 14A to me and don't disallow any expenditure. So people were claiming that since I don't have the exempt income only, you don't apply this formula, don't calculate any expenditure to be disallowed because I have not incurred any expenditure for earning that exempt income. CBDT came out with a circular in the year 2014. This circular said that in a particular year, if you have not earned the exempt income, that does not mean that you have not incurred the expenditure for earning the exempt income. You might have definitely incurred some expenditure. For example, while purchasing the shares, you called up your broker, so you incurred the telephone expenses. But that company whose the shares you have purchased has not declared any dividend. So income is not earned, but you still have incurred an expenditure. So CBDT clarified that even though in a particular year you do not have a exempt income, some expenditure might have been incurred in relation to that exempt income. So rule 8D will be applied. That amount of expenditure will be ascertained and that amount of expenditure will be disallowed. Have you understood this? Yes or no? Yes? Okay. So CBDT has clarified that the legislative intent is to allow only that expenditure which is relating to taxable portion of the income. Therefore, it follows that expenses which are relatable to earning the exempt income should be considered for disallowance, irrespective of whether such income is actually earned during the financial year or not. This section 14A not relevant for the examination since it is there in the module I have explained. So this chapter is over. Income exempt from tax. Miscellaneous was already over. Now we'll move on to, instead of return of income and self-assessment, we'll move on to the last chapter first. Computation of total income and tax liability, because this is more important. See, I have given you practical question for practice, self-practice. Practical problem for self-practice. You have to do this question on your own. Question number 1 is a compulsory question which was asked in November 19 examination. These past examination questions are only taken here. This was asked in May 19, this was asked in November 18. So I have written the attempt in which examination that was asked along with the number of marks. May 18, November 17. So last 4-5 years, one question I have inserted here to give you an idea as to which kind of questions are asked in the examination. You will get the idea if you refer to this question. Now in this chapter we are left with, in this chapter we are having only 2 sections. One is section 115 BAC, which is a newly inserted the budget 2020, and the other one is AMT provisions. AMT provisions. See this chapter starts on page number 380. Page number 380 and page number 381. They are provisions relating to alternative minimum tax. This alternative minimum tax was asked as part of examination question. In November 20, it was forming part of compulsory question. And then we have section 115 BAC, which is introduced by budget 2020. If you recollect, this was slightly covered in the basic concept chapter also. In basic concept chapter, I have already explained you section 115 BAC, but I told you that I will explain this once again in detail when we move on to the last chapter. So today we will complete this. Optional tax regime in case of individual and HUF. Means individual and HUF, they can pay tax either as per the normal tax rates. What is normal tax rates? Basic exemption limit up to 2.5 lakhs, 2.5 lakhs to 5 lakh, 5% tax, 5 lakh to 10 lakh, 20% tax, about 10 lakh, 30% tax. That is the normal slabs. In case of a resident senior citizen, 3 lakh will be the basic exemption limit. In case of a resident super senior citizen, 5 lakh will be the basic exemption limit. So individual HUF can pay tax as per those rates, those slabs. Or second option is they can go for section 115 BAC. Here the slabs are different. So they can go for section 115 BAC. But very important point to be noted is here they have not made any distinction between a non-senior citizen, senior citizen, and very, very senior citizen. Everyone is same. If you are individual, same slabs will apply to you, irrespective of your age. So first of all, this section is applicable only in case of individual and HUF. This section is introduced by budget 2020 as an alternative tax regime. And this alternative tax regime, here the slab rates, tax rates are lower. Slab rates are lower. If you want to go for these slab rates, then you will have to forego certain exemptions and you have to forego certain deductions. See, these slab rates up to 2,50,000, there is no tax. 2,50,000 to 5 lakh, there is only 5% tax. Up to this, everything is same. Thereafter, 5 lakh to 7 lakh 50, it is 10%. Whereas in normal cases, it is 20%. 7.5 lakhs to 10 lakh, normal cases, normal slab, it is 20%, here it is 15%. 10 lakh to 12 lakh 50, it is 20%. 12 lakh 50 to 15 lakh, it is 25%. Above 15 lakh, it is 30%. In normal cases, what will happen? In normal cases, once the income exceeds 10 lakh, you have to pay 30% tax. So definitely, if you are going to calculate tax liability as per this slabs, your tax liability will be lower only. But if you want to take the advantage or the benefit of this lower slab rates, then on one hand you will get the benefit, from other hand you have to forego your exemption and deduction. From the other hand you have to forego your exemption and deduction. So it is not a one-sided benefit offered by the government to the taxpayer. You enjoy or take the benefit of lower slab rates. At the same time, you forego certain exemptions and deductions. Surcharge and health and education cess would remain the same. There is no change in that. Which exemption and which deduction are required to be foregone? We have a list of exemption and deduction. This is required to be foregone. In point number 2, we have the list of exemption and deduction. If you want to go for section 115 BAC, optional tax regime, and you want to pay tax at lower slab rates, then you have to forego these things. In other words, you will not get the benefit of exemption and deduction in this section. Section 10 clause 5, leave travel concession, we discussed in this chapter of income from salary. Section 10 clause 13A. Deva madam, we will discuss, don't worry about that. The question which you are asking is covered here. It is covered in point number 1. Intentionally, I am not discussing point number 1 right now. I will discuss once we complete this exemption deduction list. First of all, we should understand which exemption deduction are required to be foregone. So what is the benefit to you? Lower tax rates. This is the benefit. What is the benefit taken away? You have to forego the exemptions and deductions. Which exemptions you have to forego? Section 10 clause 5 leave travel concession exemption you have to forego. House rent allowance exemption under section 10 clause 13A. Specified allowance exempt in section 10 clause 14. In the chapter of salary, partly taxable, partly exempt allowance. Partly taxable, partly exempt allowance. Category A, category B, category C. All those exemptions you have to forego. Except allowance granted to employee other than transport allowance, conveyance allowance, daily allowance, travel and transfer allowance. These four he can claim. He can claim exemption for transport allowance. He can claim exemption for conveyance allowance. He can claim exemption for daily allowance. He can claim exemption for travel and transfer allowance. Except these four, all other exemptions are withdrawn. You cannot claim. Children education allowance, hostel expenditure allowance, allowance received by employee working transport sector, all those exemptions you cannot claim. Allowances, daily and constituency allowance received by MP MLA is totally exempt from tax in section 10 clause 17. You know that. But here you can't take the advantage of that section. If you are MP MLA, if you are receiving daily allowance, constituency allowance, that daily allowance, constituency allowance will become fully taxable. It will become fully taxable. In the chapter of clubbing of income, you will learn that in section 64. Have you referred the clubbing chapter? Yes, that is uploaded on the app. Have you referred that? But have you seen that the chapter is appearing there? Yes. That chapter was recorded when I was in Chennai only. At that point of time only I had recorded that chapter. Clubbing and setup, these two chapters I have recorded. So you can refer from there. If you have any doubt, you can definitely message me. But while you refer section 64, subsection 1A, will come to know that income of minor child is clubbed in the income of parent. Income of minor child is clubbed in the income of parent. Here we have section 10 clause 32, which says that parent in whose income minor's income is clubbed now. Parent in whose income minor's income is clubbed. That is either father or mother. In whosoever's income minor's income is clubbed now. That parent will get exemption to the extent of 1,500 rupees per annum per child. That parent will get the exemption of 1,500 rupees per child per annum. This is the maximum exemption. But if the income of minor, which is taxable in the hand of parent, that income itself is 1,000 rupees, then the exemption will be 1,000. So exemption is nothing but actual income club or 1,500 per child per annum, whichever is lower. That will be allowed as exemption to the parent in section 10 clause 32. That exemption cannot be claimed if the parent wants to go for section 115 BS. Exemption in respect of unit set up in special economic zone, section 10 AA, 15 years tax holiday we discussed now. That you cannot claim. Standard deduction in the chapter of salary, entertainment allowance, profession tax. So mostly all these are related to salary chapter only. This you cannot claim. Then interest in respect of self-acquired property. This you cannot claim. You cannot set off the house property loss against any other positive income under any other head. Additional depreciation cannot be claimed. 32 AD cannot be claimed. See, 30 to 80 anyway it is expired. While drafting this entire provision, government has not applied the mind. Investment allowance deduction under section 30 to 80 is already expired on 31st March 20 only. So they should have not mentioned this point. There was no need. Tea, coffee, rubber development account section 33 AB. Site restoration fund 33 ABA. These two sections are not part of your CA intermediate syllabus. Deduction for scientific research in section 35. Deduction for specified expenditure incurred for specified business 35D. Agricultural extension project 35CCC. 35CCC. 35CCC na, not part of your syllabus at intermediate. Dixit is asking me, can I claim deduction for interest in respect of let out property? Yes, in connection with let out property, you can take the advantage. Because that let out property will get some income also now. In let out property, you also earn some income. Therefore, for that property, government says will give you deduction for interest. But in case of let out property, if you are having final amount of income from house property as loss, then that loss cannot be adjusted against some other positive income. Set off of loss will not be allowed. If in case of let out property, finally you are having a negative income, then that negative income will not be allowed to be adjusted against some other positive income. Set off will not be allowed. Standard deduction. In the chapter of IFOS, we had discussed standard deduction for family pension. Do you remember that? 1/3 of amount received or 15,000, whichever is lower, will be allowed as standard deduction from family pension. That also you cannot claim. You cannot claim chapter 6A deduction. Section 80C, 80CCC, 80D, 80DD, DDB. This section you cannot take the advantage. However, you can take the benefit of 80CCD subsection 2. 80CCD subsection 2 you can take the advantage. 80JJAA deduction can be claimed and section 80LA deduction can be claimed. These three deductions can be claimed. These three deductions can be claimed. Expenditure in respect of voucher granted for free food or beverage to employee is also cannot be claimed. Do you remember section 17 subsection 2 clause 8 fringe benefit, free meal and refreshment food is provided to employee through vouchers usable at eating joints. If it is a cost per meal is up to 50 rupees, it is exempt from tax. That benefit is not available yet. If you take the advantage of section 115 BSc, that benefit is withdrawn. Any exemption or deduction for allowance or perquisite provided under any law. So all these exemption and deduction you have to forego if you want to go for section 115 BSc. If you want to go for section 115 BSc, then you have to forego all these exemption and deductions. Then we have list of exemption which you can claim. We have the list of exemption which are available. So this exemption you can claim. Section 10 clause 10 gratuity, section 10 clause 10A computed pension, 10AA leave salary, section 10 clause 10B retrenchment compensation, section 10 clause 10C VRS compensation, section 10 clause 10CC tax on non-monetary perquisite paid by employer, section 10 clause 10D maturity proceeds of LIC, section 10 clause 11 in the amount received on public provident fund, section 10 clause 11A maturity proceeds of Sukanya Samriddhi account scheme, section 10 clause 12 amount withdrawn from recognized provident fund, section 10 clause 12A and 12B amount withdrawn from national pension scheme, notified pension scheme, section 10 clause 13 amount withdrawn from approved superannuation fund. All these exemptions can be claimed. even if you go for section 115 BAC, this exemption will be available to you. These exemptions can be claimed. Is that very clear? Yes or no? Okay. Now point number 4 talks about adjustment of certain brought forward laws. See, this is the first time this section has come into existence now. So this is optional for you. Now, for example, you have decided, yes, I want to go for this section. You have decided, yes, I want to go for this section. In that case, you are in point number 2. It is mentioned that you cannot take the advantage of this exemption and deduction. Now, let me give you one example. Last year, that is previous year 1920, you might have calculated income from self-occupied property. This provision says that we are not going to give you deduction with respect to interest in case of self-occupied property. Now, current year you want to go for section 115 BAC. We are saying that current year we are not going to give you any deduction with respect to interest in case of self-occupied property. That is okay. But last year you might have claimed deduction, as a result of which your final income in case of self-occupied property would have been negative. You might have claimed deduction for interest in the last year now. Because of that, your final income from self-occupied property, definitely it would have been negative only. That negative, if you have not adjusted against some other positive income in the last year itself, then that loss will be carried forwarded from the last year to the current year. It will be called as brought forward loss. Are you understanding what I am trying to explain you? I am not talking about 2020, previous year 2021. I am talking about previous year 1920. This section came into existence only from previous year 2021. But this says what? It says that in the last year you might have claimed all these deductions. As a result of claiming these deductions, your final income may have turned to be negative. So I have taken an example of income from house property to make you understand this important point. In last year, you might be having some self-occupied property. In connection with that self-occupied property, you might have claimed deduction with respect to interest in last year. Your final income from house property in case of self-occupied property would have been negative. That negative, possibility one, you would have adjusted entirely in the last year itself against some other positive income. Against some other positive income, you have adjusted that entire negative in the last year itself. That is first possibility. Second possibility is, last year you could not adjust. Last year you could not adjust because you did not have any other positive income. Then what you will do? You will carry forward that income from self-occupied property loss. You will carry forward to the subsequent years. So for the last year, there was a carry forward loss. That loss will come to the current year. It will be called as brought forward loss. Can I say that brought forward loss is exclusively because of interest in respect of self-occupied property? Because in respect of self-occupied property, you get deduction only for interest now. If there is a loss, that loss is because of only one factor, interest in respect of self-occupied property. Yes or no? So government says what? In point number 4, government says, if you have some brought forward loss, and that brought forward loss is in connection with all exemptions and deductions which you have to forego. This all exemptions and deductions you have to forego now. Because of this exemption and deduction in the last year, in the current year you are having some brought forward loss now. That brought forward loss we will not allow you to adjust. That brought forward loss we will not allow you to adjust. that brought forward loss will also lapse. That brought forward loss will also lapse. Have you understood this? Yes or no? So point number 4 says the total income of the individual HAF shall be computed without adjusting the brought forward loss from any earlier year. If such loss or depreciation pertains to deduction exemption which is covered in point 2 above. Moreover, loss under income from house property cannot be set off with any other income under any other head of income. So IFHP losses cannot be set off against any other income other than IFHP. And if you have a brought forward loss because of claiming those exemption and deduction in the past years, that brought forward loss also we will not allow it to adjust. Point number 5, adjustment of depreciated value of block. Depreciated value of block means value of block at the beginning of the year. See, you might be having some brought forward loss or brought forward unabsorbed depreciation. Do you remember unabsorbed depreciation? Yes or no? Unabsorbed depreciation, do you understand? The amount of depreciation for which you could not claim deduction because of insufficiency of profits. Your profits are insufficient. You cannot claim deduction for depreciation. That amount will be called as unabsorbed depreciation. So, if you have some brought forward loss or depreciation as mentioned above, that shall be deemed to have been given full effect to, and no further deduction will be allowed for such loss or depreciation. So, if some amount of depreciation is unabsorbed, which you have brought forward in the current year, if some business loss is unabsorbed, which you have brought forward in the current year, we will not allow you any set off for that business loss or unabsorbed depreciation. That is deemed to have been allowed. No further deduction for such loss or depreciation shall be allowed in any subsequent year. However, the unadjusted depreciation in respect of block of asset has not been given full effect to prior to the assessment at 21-22. Corresponding adjustment shall be made to the WDV. In other words, if you have some unabsorbed depreciation, if that unabsorbed depreciation is not adjusted in the value of block, then from value of block you have to reduce. So the value of block should reduce, but you will not get deduction. You will not get deduction, but still you have to reduce that depreciation from the value of block. Which depreciation? Unabsorbed depreciation. So that unabsorbed depreciation should have been reduced from the value of block. If SSE is exercising option in section 115 BAC, then AMT provisions are not applicable. If SSE is exercising option in section 115 BAC, then AMT provisions are not applicable. What do you mean by AMT provisions? That we'll understand later. After this section, we are going to move on to that AMT provision only. Now, I need to move on to the first point. First point is explaining you that this section is optional section. It is not mandatory for the SSE to exercise the option in this section. Who can exercise option? Once option is exercised, can you take exit from the section? Every year, will you calculate income as per the normal provisions, income as per section 115 BAC? Then you will select the option wherever your income is low, wherever your tax liability is less. Can you do this? All these things are explained here. Manner of exercise the option for the new scheme. It says new scheme is optional, and the SSEs will have to opt for being covered by the new scheme in the prescribed manner. So this scheme is optional. You have to exercise the option. Individual HUF not having PGBP income. Individual HUF not having PGBP income means they are having income under salaries, house property, capital gain, other sources. This individual, they are required to exercise the option every year while they are filing the return. So while the income tax return is filed, there you will have an option. Do you want to go for section 115 BSc, yes or no? If you say yes, I want to go for section 115 BSc, then accordingly your tax liability will be calculated. So this individual HUF who are not having PGBP income, na, every year they have to exercise the option. So every year they will calculate income without taking certain exemption and deduction. On that, they will calculate tax liability as per the slabs given in section 115 BSc. On the other hand, they will take the benefit of exemption and deduction. They will take the benefit of exemption and deduction. And they will claim, they will calculate the tax liability as per the normal provisions. Then they will compare both the options. Wherever their tax liability is less, they would go for that option. So individual HUF who are not having PGBP income, every year they can change the option. Whichever option is beneficial, they will adopt that option. Point 2 says, an employee not having PGBP income can opt for lower tax regime under section 115 BSc by intimating the employer. See, in section 192, we have discussed that employer has to deduct the TDS of employee. Employer has to deduct TDS of employee as per which rate? Slab rates. So the question arises, which slab rates are required to be applied? Slab rates given in the Annual Finance Act are required to be applied, or slab rates given in section 115 BSc are required to be applied? Because employer has to deduct TDS. So while deducting TDS, employer has to calculate the estimated tax liability of employee. That estimated tax liability, how he will calculate? Will he apply the normal slab rates, or will he apply the slab rates as per section 115 BSc? That is the question. So point number 2 says, employee who is not having any business income and he wants to opt for section 115 BSc, he can intimate his option to the employer, saying that I want to go for 115 BSc. So employer will accordingly calculate his income. He will not give you the benefit of exemption deduction, and employer will calculate the tax liability by applying the provisions of 115 BSc. These slabs will be applied. Tax liability will be calculated. That tax liability will be deducted from your salary in the form of TDS equally every month. So employer shall deduct TDS accordingly. If intimation is not made by employee, then employer shall deduct TDS, ignoring the provisions of section 115 BSc. If you don't intimate to your employer, then he will calculate tax liability as per the slab rates given in the Annual Finance Act. Now, this is a very important point. Such intimation to the employer does not amount to exercise of option. Why you are intimating to the employer? Na? So that while deducting TDS, he will consider 115 BSc and accordingly he will calculate the amount of TDS. But still it is not mandatory for employee to go for section 115 BSc. For example, employee has intimated to the employer saying that I want to go for section 115 BSc, so deduct my TDS as per section 115 BSc. But at the end of the year, employee has realized that normal provisions, slab rates which are given in the Annual Finance Act, normal provisions, they are more beneficial to me. They are more beneficial. So can he exercise the option now? Yes. Whatever he has what intimation he has given to the employer, that does not amount to exercising the option at all. Option is to be exercised only at the time of filing the income tax return. The intimation which you are giving to employer is only for TDS purposes. That doesn't tantamount to exercising the option. So such intimation to the employer, that does not amount to exercising the option by the employee. Employee is required to exercise the option at the time of filing his income tax return. At the time of filing his income tax return. Have you understood this? Yes. Point number 1, 2, 3. Have you understood? So before we move on to point number 3, point number 1, 2 is completed. Point number 1, 2, I am summarizing for you. Employ any person not having PGVP income. Any person not having PGVP income can exercise the option in section 115 BSc every year. Every year he can change the option. Employee who wants to exercise section 115 BSc option, he has to exercise the option. Everyone has to exercise the option at the time of filing the income tax return. So if employee wants to go for section 115 BSc, then he has to exercise the option at the time of filing the income tax return. But beforehand, at the beginning of the year itself, he has to intimate the employer that whether he wants to go for section 115 BSc or he doesn't want to go for section 115 BSc. So that employer will accordingly deduct the TDS. But the actual exercising of option will be done only at the time of filing the income tax return, intimating the employer. The intimation which you send to the employer is only for the purpose of TDS, not for any other purpose. Now Deva madam is asking me, sir, if employee has intimated to the employer that I want to go for section 115 BSc, so you deduct my TDS accordingly. And thereafter, while filing the income tax return, employee says, I don't want to go for section 115 BSc, I want to go for normal provisions. In that case, employer has deducted TDS as per section 115 BSc. So, question is whether employer will have to again deduct TDS as per the normal provisions. Have you understood the question she is asking to ask? Yes? Have you understood the question she is asking? Yes or no? You want? I'll repeat. Dikshit, I'll repeat for you. Listen to me carefully. See, what Deva madam is saying, in previous year 2021, your employer will start deducting TDS from your salary income, na? So, he has to calculate tax liability. The tax liability will divide it by 12, and equally he will deduct TDS from your salary income. Question is, should employer deduct the tax liability calculating the tax as per the normal provisions or calculating the tax as per section 115 BSc? That employee has to intimate to the employer. So for example, in the month of April 2020, employee has intimated to the employer that yes, I want to go for section 115 BSc. Then what will happen? Employer will calculate the total income. Employer will not give him the benefit of exemption and deduction. Those exemption deduction which are required to be foregone, those benefits will be taken away. Total income will be calculated. Tax liability will be calculated by applying the slab rates given in section 115 BSc. To that, you add surcharge, you add cess if applicable. Cess is always applicable. Then you find out the final tax liability. So employer has found out the final tax liability. He is dividing that final tax liability by 12 and he is deducting TDS as TDS every month. This tax liability is ascertained by applying the provisions of section 115 BSc. Till now, have you understood, Dikshit? Dikshit? Yes, okay. So I'm just telling you that employee has exercised the option. Employee has intimated to the employer saying that I want to go for section 115 BSc, and employer has accordingly calculated the tax liability, and that tax liability which is calculated as per section 115 BSc, that is deducted from employee's salary in the form of TDS. Now, I explained one point saying that the intimation which we are sending to employer that doesn't amount to exercising the option. I will have to exercise the option at the time of filing income tax return only. So now I am saying that at the time of filing the income tax return, if I feel that tax liability as per the normal provisions is less as compared to tax liability as per section 115 BSE. So what I will do? I will definitely go for tax as per normal provisions. So in that case, the question which was asked by Deva madam was, at the time of filing income tax return, if you want to go for normal provisions, but your employer has deducted TDS as per 115 BSE. Employer has deducted TDS as per 115 BSE. Now you are saying that you want to go for normal provision. In that case, will employer again deduct TDS, again calculate TDS as per the normal provision? That is the question. Have you all understood this question? Yes. Now listen to me carefully. Instead of answering this question, I'm putting a counter question. I am putting a counter question on it. My question is, why employee would like to go for normal provision? What would be the reason for that? Employee has intimated to the employer that I want to go for section 115 BSE. Now at the time of filing return, he has changed his mind, saying that I want to go for normal provision. Why he might have changed his mind? What would be the triggering event? Because he has realized that my tax liability as per the normal provision is less. Yes or no? Deva madam, because employee has realized that my tax liability as per the normal provision is less. Therefore, he wants to go for normal provision. In that case, my question to you is, don't you feel that employer might have deducted more tax? If tax liability as per normal provision is less, then tax liability as per section 115 BSE is more, na? So employer has already deducted more tax. Don't you feel so? In that case, employee will exercise the option in section, employee will go for normal provision. And in that case, his tax liability is less, but more TDS is already deducted. So in his case, he will get a refund. In that case, he will get a refund. Yes or no? Have you understood this? Employer has deducted more TDS as per section 115 BSE. His tax liability as per normal provision is less. So his tax liability is less as compared to the TDS which is already deducted. So in that case, we say that he will get a refund. He will get a refund. Is that very clear? Yes. Okay. Now let's move on to the last point. Right now we have discussed Rizwan. Rizwan, question of advance tax will not arise. Listen to me carefully. If employee is having only salary income, etc., or he is having some other income also, in the chapter of TDS TCS advance tax, while explaining you section 192, if you recollect, I told you that employee has the option to inform his income under other heads to the employer. Employee can just pick up a piece of paper. On that he can write, this is my capital gain income, this is my IFOs. All this information he can give it to employer. If employee is given details of other income to the employer, then employer will also deduct TDS on this other income. So in that case, advance tax provision will not be applied, because from the tax liability, if you deduct TDS, etc., then the balance advance tax liability will be less than 10,000. So advance tax provision will not apply at all. And if employee does not intimate his income under other heads to the employer, and his advance tax liability is 10,000 or more, then he will pay advance tax also. While filing his income tax return, he will go for normal provision or 115 BSE, whichever is beneficial to him. He will calculate tax liability accordingly. From that tax liability, TDS will be deducted, advance tax will also be deducted, TCS will also be deducted. Credit will be claimed for TDS, TCS, advance tax, all of them. Once that is deducted, TDS, TCS, advance tax will be deducted from total tax liability. Thereafter, if the amount is positive, then employee will get the refund. Then SSC will get the refund. Rizwan, have you understood? Yes. Deva madam is saying means he opted for normal provision but paid a tax as per 115 BSE and balance he will get refund. Madam, your sentence is slightly not framed properly. Whatever you are trying to say is correct. He has opted for normal provision, but his tax was deducted as per 115 BSE. Tax was deducted in section 192, but that tax was calculated as per section 115 BSE. His tax as per normal provision is less as compared to 115 BSE. So balance amount he will get as refund. Is that very, very clear? Now, let us move on to the last part. See, this point number 1, this point 1, we can make a very small flowchart, small and simple flowchart. Individual HUF, we can bifurcate individual HUF into two categories. Number 1, having PGVP income, and number 2, not having PGVP income. Individual HUF not having PGVP income can exercise option of 115 BSE every year at the time of filing income tax return. So it is not mandatory for them to stay in section 115 BSE. Every year they will decide whichever option is more beneficial, they will go for that option. And those individual HUF who are having business income, they have to exercise the option under section 115 BSE at the time of filing the income tax return. Once the option is exercised for section 115 BSE, then they have to stay in that section only. Then next year they cannot come out of 115 BSE and go for normal provision. If they come out of section 115 BSE and they go for normal provision in the next year, then we will not allow them to re-enter section 115 BSE. If you recollect, in the chapter of PGVP, we had discussed one section, section 44 AD. In the chapter of PGVP, we discussed one section, section 44 AD. In section 44 AD, there was a provision saying that once SSC goes for section 44 AD, once SSC declares income as per the provision of section 44 AD, for the next 5 years also he has to declare income as per section 44 AD only. He has to declare income as per section 44 AD for next 5 years. If he is exiting the section before completing 5 years, then he will not be allowed to enter the section, re-enter the section for the next 5 years. Similar kind of restriction they have inserted here in section 115 BSE for those people, for those individual HUF who are having business income. So, for those individuals and HUF who are having business income, first year they have to exercise the option. Presumptive 4480 business, that provision continues. See, Sarvana, section 4480 was for the purpose of computation of income. 115 BSE is not for computation of income, it is for computation of tax liability. The basic purpose of these sections are different. Are you understanding? Basic purpose itself is different. 4480 still will be applied. If SSC wants to go for section 4480, he can go. I am just trying to compare the provisions to explain you that similar provisions are inserted here also. So if you go for section 115 BSc, if you are an individual HUF having a business income, and if you go for section 115 BSc, if you go for section 115 BSc, then you have to stay in that section only, year after year. For all the subsequent year, you have to stay in that section only. For all the subsequent years. If you come out of section 115 BSc, then re-entry is disallowed forever. We will not allow you to re-enter the section. Re-entry will be allowed only in one circumstance. That is, your business is discontinued for few years. For few years, you are not having business income. And after a few years, you started some other business. In that case only, you can re-enter the section. Otherwise, once you take the exit from section 115 BSc, your entry into section 115 BSc is restricted. We will not allow you to re-enter into the section. Have you understood this very clearly? Yes or no? Let us read this, what it says. If an individual HUF have PGBP income, then option needs to be exercised on or before the due date of filing return of income. Such option, once exercised, shall apply for that previous year and for all subsequent years. Once opted out of the new scheme, re-entry is not allowed. Once you opt out from the new scheme, re-entry is not allowed, except when he ceases to have any business income. Except when you cease to have any business income, you can get into section 115 BSc. Is that very, very clear? Yes. Okay. Now see, since section 115 BSc is a newly inserted section, I have explained the provision to you, but I have not inserted any practical question on this. I am having practical question on section 115 BSc. I am having practical question also on section 115 BSc. What I will do now? Questions which are pertaining to section 115 BSc, exclusive questions on section 115 BSc. I will send you the PDF in that WhatsApp group along with solution. Along with solution, I will send you 1-2 questions of section 115 BSc in your WhatsApp group. You can refer to that section 115 BSc practical question. Yes, today I will send you in that WhatsApp group, so you can refer it today, and if you feel, we will discuss tomorrow. Rizwan says what? In April, 115 BSc is beneficial. Normal provision is benefit. Calculation will be in April as per 115 BSc and in May as per normal provision. Rizwan, at the beginning of the year, you have to intimate your employer if you want to go for section 115 BSc. If you don't intimate anything, then he will by default go for normal provisions. Then if you intimate that yes, you want to go for section 115 BSc, then you can't change the option again and again. Anyway, you are not exercising the option. This is only for the purpose of TDS only. Only for the purpose of TDS, you are intimating the employer. Now you do one thing, at the time of filing return only, you decide whether you want to go for 115 BSc or not. Let the TDS get deducted as per section 115 BSc liability only. Let TDS get deducted as per 115 BSc only. Dikshit, which point you are talking about? This point? Dikshit? Okay. This point says what now? This point is saying two things. Number one, if you go for section 115 BSE, and if you are having some brought forward losses and brought forward unabsorbed depreciation, then that brought forward losses and brought forward unabsorbed depreciation, we will not allow you to set off. Unabsorbed depreciation is generally set off against the business income. Last year you did not have positive business income, so you have carried forward the unabsorbed depreciation to the subsequent year. So in current year you are having brought forward unabsorbed depreciation. In current year, if you go for section 115 BSE, then we will not allow you to set up that brought forward unabsorbed depreciation. But yes, still that unabsorbed depreciation you should deduct from the value of block, and you should reduce the value of block. Is that very clear, Dikshit? Yes. Okay. So we have completed section 115 BSE. 115 BSE practical question I don't have in the notes. When I made your notes at CA intermediate, I have not inserted practical question. CA final I have inserted. So I'm going to take those CA final questions of section 115 BSE and I'll send you in PDF. You refer to those questions along with solution, and then if you feel that those questions are required to be discussed, then we can discuss tomorrow. But I don't think so. You will feel, because it is a normal, very simple question only. So 115 BSE section is over. After the break, we'll start with alternate minimum tax. Actually, this is a CA final topic. It should not be appearing in CA intermediate. Unfortunately, unfortunately, CA Institute has inserted this AMT provisions in module, and unfortunately, they have also asked in the examination number 20, because they knew that no one is teaching this. So now, since they have asked in the number 20 examination, every teacher, every coaching class, they have started teaching these provisions. So we'll discuss the alternate minimum tax provisions today, and we will also solve a practical question on that. We have question number 1. I have one question for this, for understanding this AMT provisions. Yes, so we'll have a break right now. After the break, we can move on to AMT provisions. Once the AMT provisions are discussed, we'll discuss a practical question on AMT, and thereafter, if some time is left today, then we'll move on to return of income chapter also. 2-3 small sections we will discuss today. And tomorrow, return of income chapter will get completed in first around 3 hours. And thereafter, if you feel, we will discuss question relating to section 115 BSE, which I'll be sending you in the group today. If you feel, we will discuss tomorrow. So we'll have a break of 30 minutes up to 9:25. 9:25. If any one of you are having any doubt, you can ask me right now. Rizwan, this I told only for business income. This I told only for those people, those individual HF who are having business income. Once you get into section 115 BSE, you have to stay in that section only forever. You cannot exit the section. If you exit the section, we will not allow you to re-enter the section. We will allow you to re-enter the section only in one situation: if your business income is discontinued. If your business income is discontinued. This one, there are two things. Number one, actually exercising the option of section 115 BSc. That option is required to be exercised only at the time of filing the income tax return. If you are doing a job, you have to intimate to your employer whether you want to go for 115 BSc or not, so that accordingly he can deduct the TDS. And for those people who are not having business income, they can change the option year after year. They can change the option every year. But those who are having business income, they can't change the option every year. Yes, is that very, very clear? Rizwan? So now let's move on to alternate minimum tax provisions. I have sent you that PDF. In that I am having two questions of section 115 BSc. Section 115 BSc. There are two practical questions along with solution I have sent you. Kindly refer those. Those are very important for the purpose of examination. Refer those. Tomorrow we'll have time. We'll refer to that. So now we move on to alternate minimum taxation system. Those provisions are given here. Chapter is starting from page number 380. The first part of the chapter is alternate minimum tax. I want to just ask you a very simple question. If SSC is claiming deduction under section 35AD for specified business, if SSC is claiming deduction under section 35AD for specified business, if SSC is claiming deduction under section 10AA for profit earned from export turnover of SEZ unit, and SSC is claiming certain income-based deduction. This income-based deduction, every section is not part of your syllabus. So we are moving on to the chapter of alternate minimum tax. It is chapter 12BA, section 115JC to section 115JF. Before we actually move on to discuss this, I want to simply ask you a question. If SSC is claiming deduction under section 10AA, what is deduction under section 10AA? Deduction for profit of export turnover of SEZ unit. If SSC is claiming deduction under section 35AD, what is deduction under section 35AD? Deduction for capital expenditure in respect of specified business. If SSC is claiming deduction, income-based deduction under chapter 6A, which are income-based deduction under chapter 6A, section 80IA, 80IB, 80IC, 80ID, 80IE, 80IAB, 80IBA, 80JJAA, QQB, RRB. So there are many sections of income-based deduction in chapter 6A. These sections are not part of your syllabus. What I have already taught you is 80JJAA, 80QQB, RRB, TTA, TTB. That's all. But what do you mean by income-based deduction? Section 10AA is also income-based deduction only. Income-based deduction means whatever income you have earned, that is taxable under that PGBP. So we will calculate income under all the 5 heads. We'll take the total. That will give you gross total income. From that gross total income, while claiming chapter 6A deduction, certain portion of your business income will be deducted. We will give you deduction for certain portion of your business income itself. So from gross total income, you will be allowed a deduction with respect to certain portion of your income from a specific business. That is nothing but a income-based deduction. Income-based deduction means deduction will be calculated based on the amount of income. For example, government says that telecommunication business, 50% income will be allowed as deduction. Telecommunication business, 50% income will be allowed as deduction. That is what is written in section 80 I. am just giving you example. Don't get into those sections. Anyway, this is not forming part of your syllabus. For example, government says if you do telecommunication business, 50% profits will not be taxable. Now, say for example, your profits are 20 crores. So these 20 crores would form part of your business income. So in the profits and gains of business profession, this 20 crores will form part of your business income. 50% of 20 crores, that is 10 crores. The 10 crores will be allowed to as deduction in section 80 IA. So what will be forming part of a gross total income is 20 crores, and then from that 20 crores, you will deduct this 80 IA deduction to the extent of 10 crores. So from the gross total income, we are deducting some portion of the business income. Therefore, it is called as income-based deduction. The amount of deduction is calculated based on your income. Generally, deduction word is always used in context of expense. But here, in deduction word is used in context of income. From your gross total income, we are deducting certain incomes which are earned by you and they are taxable under that PGBP. For those income, we are giving you deduction. Now, my question to you is, because of claiming deduction under section 10 AA, under section 35 AD, under section 80 series, what is the consequence? Your total income, taxable income will fall down. It will reduce or it will increase. Because of this deduction, your income will increase or it will reduce. Yes? No, tax liability is less, that is correct. Dixit, tax liability is less, that is correct. But my question is, because of claiming such huge deductions under section 35D, section 10 AA tax holiday for 10 years, 15 years, income based deduction in chapter 6A, as a result of this, your total income will reduce or total income will increase? Yes? Your total income will drastically reduce. Your total income will drastically reduce. For example, you have learned section 10 AA. In section 10 AA, SSE is enjoying a tax holiday for 15 years. For first 5 years, 100% deduction. For next 5 years, 50% deduction. For next 5 years, 50% deduction, subject to the condition that he transfers equivalent amount to Special Economic Zone Reinvestment Allowance Reserve account. He is enjoying tax holiday for 15 years, 15 long years. So what will happen during those 15 years? Because of such heavy deductions, your income will drastically fall. Your tax liability will be very less. And once the period of 15 years is over, now you are no more eligible for deduction. So what will happen? Your income will drastically increase and your tax liability will drastically increase. So what is happening is, if we just take the example of section 10 AA, then for 15 years, government will get less tax. Government will get less tax. And from 16th year onwards, government will get very high tax. Because now entire income will become taxable. So do you understand that the government's tax collection for certain period it is too low and for certain period it is too high? So as a result of giving you such heavy deductions, your total income is too less and your tax liability is too less. Since tax liability is too less, government is not getting any tax. And once you are out of the tax holiday period, government will get heavy taxes. Government says, we want to stabilize our tax collection. We want to stabilize our tax collection. Therefore, we are coming out with a concept of alternate minimum tax. We are coming out with a concept of alternate minimum tax. What is this alternate minimum tax? It is an alternative mechanism for calculating the tax liability. It is a alternative mechanism for calculating the tax liability. Now, first of all, you calculate the tax liability by applying the normal provisions of the income tax. Say, for example, your tax liability calculated by normal provisions of Income Tax Act is only 2 crores. Your tax liability, as per the normal provisions, is only 2 crores. Now, government has come out with this alternate minimum tax mechanism. As per this alternate minimum tax mechanism, government says you calculate the tax liability as per the procedure which we have laid down here, and you calculated the tax liability as per that procedure. As per that procedure, your tax liability is 2.5 crores. Your tax liability as per normal provision is 2 crores. Tax liability as per alternate minimum tax provision is 2.5 crores. Then how much amount you have to pay to the government? You have to pay 2.5 crores to the government. Now you will say that, no, why should I pay 2.5 crores? Because my tax liability is only 2 crores now. Why I should apply all these things? Because government wants to ensure that their tax collection is stable. It doesn't fluctuate it doesn't fluctuate very highly. It should not be very high tax collection or very low tax collection. It should be stable collection. Therefore, government says, by making this alternate minimum taxation concept, what we are going to ensure is every year we will get some amount of tax from it. Every year we will get some minimum amount of tax from it. That is called as alternate minimum taxation. So you have to pay us at least minimum tax, which is calculated as per alternate minimum taxation. And then whatever extra tax you have paid as compared to normal tax which you are supposed to pay, for that we will give you credit in future. In my example, say for example, tax as per normal provision is 2 crores and tax as per alternate minimum scheme is 2.5 crores. Then you have to pay how much to the government? 2.5 crores. Actual tax liability was, as per normal provision, only 2 crores. But as per alternate minimum tax, you have paid 2.5 crores. So how much extra you have paid? You have paid 50 lakhs extra. You have paid 50 lakhs extra. Government says this 50 lakhs we will allow you to adjust in future. This 50 lakhs now, extra tax which you are paying right now, we will allow this tax to be adjusted against your future tax liability. Have you understood the background of this section? Government cannot afford. I am searching for one example. If I get that example, do one thing. I'll give you one example. I'll give you one example, fresh example. Can you see the word file? Yes. Okay. See, in this, what you have to do now? I'm just trying to explain you the background of this alternate minimum taxation system, why it was introduced. For example, your total income as per normal provisions. Your tax on total income as per normal provisions. It is say 100. tax as per AMT provisions. Now, say for example, it is year number 1. You have started the new business. It is year number 1. Your tax as per normal provision is say 100, and tax as per AMT provision is 120. So government says if the tax as per AMT provision is more, then you pay tax as per AMT provision. If tax as per normal provision is more, you pay tax as per normal provision. So basically, government wants you to pay either A or B, whichever is higher. Tax payable is higher of A and B. So in this example, how much you have to pay? In year number 1, how much tax you have to pay? In this example, how much amount of tax you have to pay in year number 1? You have to pay 120. You have to pay 120. 120 is payable to the government. Now tell me, have you paid something extra as compared to what was payable? Tax payable as per normal provision in your case is how much? 100. But government has come out with some alternative mechanism for calculating the tax liability. As per that alternative mechanism, your tax liability is turning out to be 120. So you have to pay 120. Now question is how much extra you have paid as compared to your normal tax liability. Because of this alternative mechanism of calculating the tax, you are paying 20 extra. For this 20, we will give you credit. This 20 we will give you credit. This can be set off against the future tax liability. This can be set off against the future tax liability. Now, for example, year number 2. Year number 2, once again your tax as per alternate minimum tax mechanism is 130. So how much you have to pay to the government? 130. How much credit you will get? 30. Will get credit of 30. What you will do about this 30? This you can set off in future. When you can set off? When your tax liability as per normal provision is more. This credit, 20 credit can be carried forward for 15 years. For this 20, you can carry forward the credit for how much? How many years? 15 years. So, in year number 1, you have paid how much tax? Extra 20. This can be carried forward for next 15 years. Next 15 years means up to which year? Up to 1 plus 15. That is up to year number 16. Up to year number 16, we will allow you to carry forward this 20 credit. And you can set off in future. If you could not set up this in future, then after the expiry of 15 years, that will lapse. Year number 2 also, there is a credit of 30 that can be carried forward for next 15 years. So year number 2 plus 15 is up to year number 70. Now say for example, year number 3, tax as per AMT is 90. Tax as per AMT is 90. How much tax you will be required to pay to the government in year number 3? You have to pay higher of A and B. So you have to pay how much? 100, correct? Yes or no? This 100 is as per normal provision or this 100 is as per AMT provision? This 100 is as per which provision? This 100 is as per normal provision. So government says, in this year you can set off. Can you tell me tax as per normal provision is how much more as compared to tax as per AMT? 10. 100 minus 90. 10. Correct. So up to this 10, up to 10, AMT brought forward can be set off. How much AMT you are having brought forward AMT? What is the brought forward AMT balance for you? What is the brought forward AMT balance? So brought forward AMT credit is how much? 50. Year number 120, year number 230, total 50. Out of this 50, we will adjust 10. So balance will be 40. We have adjusted 10 here. Up to 10, brought forward AMT can be set off. So how much you are required to finally pay to the government in this year number 3 is 90. In year number 3, you will have to pay 90 only. In other words, in any year, your tax liability cannot be less than point number B. This point number B is the minimum tax which you have to pay to the government every year. Point number B is the minimum tax which you have to pay to the government every year. You can pay more than point number B, but you cannot pay less than point number B. Whenever your tax as per normal provision is more as compared to tax as per AMT, then against the excess, you can set off the brought forward AMT credit. Now say for example, year number 4, your tax as per AMT provision is 110. So how much you have to pay to the government? 110. How much credit you will get? 10. So what was the credit left? 40. 40 was there. You will get 10 right now. So what is the balance now? 50. Have you understood how the calculation will work? Yes? Okay. Now let us go through the provision. Now let us understand what the provision says. See, first of all, this alternative mechanism of calculating the tax liability is applicable to whom? It is applicable only to those it is applicable only to those SSCs who are claiming any of these 3 deductions. SSC who is claiming deduction in 10AA, SSC who is claiming deduction in section 35 AD, or SSC who is claiming income based deduction in section 80 IA series. Only to those SSCs this chapter is applicable. This alternative mechanism to calculate the tax is applicable. And that too, only SSCs other than company. Why these provisions are not applicable to company now? Because to company we have a separate provisions called as MAT provisions. This is alternative minimum tax. For company we have something called as minimum alternative tax. Minimum alternative tax. This concept was first introduced for the company, and thereafter it was introduced for others. So first of all, one second, this one second. Any one of you having any doubt here? In example, any one of you having any doubt? How the calculation will flow? Rizwan, in year number 1, you have to pay 120. In year number 1, you have to pay 120 to the government. Your tax liability as per normal provision is 100, but you are paying 120. So that 20 extra paid now. The 20 you can carry forward to the subsequent year. That carry forward is allowed for 15 years. Rizwan, have you understood? This extra 20 you don't have to pay in future. You are actually paying the right. You are paying in the current year itself. Current year, how much is tax payable to the government? 120. So you have paid already something extra over and above your actual liability. You have paid 20 extra. That 20 extra paid will be allowed to as credit, and this credit will be adjusted in future. In future, it will be adjusted in which year? In the year in which your tax liability as per the normal provision is more as compared to tax liability as per AMT. And in future, this will be adjusted against what amount? It will be adjusted against tax payable as per normal provision minus tax payable as per AMT. In other words, in any year, tax actually payable to government cannot be less than this column. It cannot be less than this amount, because this is the minimum amount of tax which you have to pay to the government. You cannot pay less than this. Is that very clear, Rizwan? Okay, yes. So now listen to me carefully. To whom these provisions are applicable? Only to those SSEs who are other than company. So individual, HUF, firm, association of person, body of individual, artificial juridical person, etc. To these people, to these persons, these provisions are applicable. That too, provided they are claiming any deduction under Chapter 6A or deduction under Section 10AA or deduction under Section 3580. Then only these provisions will be applicable. If these provisions are applicable, what you have to do? You have to calculate tax as per normal provisions and you have to calculate tax as per AMT. First of all, you have to check who is SSE. Is SSE other than company? If the answer is yes, then you have to check whether SSE has claimed any deduction under Section 10AA, 35AD or income-based deduction in Chapter 6A. If yes, then tax liability is required to be computed as per the AMT provision. Now, in this example, I just gave you the rough amount saying that tax as per the normal provision is 100, tax as per AMT is 120, 130, 90, 110, etc. But the question is how to calculate this 100, 120, how these amounts are derived. For making you understand, I just gave you the example of some numbers. But how these numbers will be calculated, tax as per normal provision and tax as per AMT, how this will be calculated, that is what we need to understand here. So first of all, you have to calculate regular income tax payable. Regular income tax payable means as per the normal provisions of income tax. Say for example, if you are individual, first of all, you calculate your total income. You calculate your total income under IFHP, salary, PGP, capital and other sources, everything. Then you get gross total income. Then you claim Chapter 6 deduction. And then you get the taxable income. So from that taxable income, in that taxable income, you might have already claimed 3580, 10AA, 80 IS series deduction. On that total income, you calculate tax as per normal provision. To that, if you add surcharge, if applicable. To that, you add surcharge, if applicable. You know surcharge is applicable only when the income is more than 50 lakhs. Once you add the surcharge, you will get the amount of tax plus surcharge. On that tax plus surcharge, you add 4% health and education cess. You add 4% as health and education cess. So your step number 1 is to calculate tax liability as per normal provision. For that, what you have to do? You have to calculate total income. When we say total income, it is always after deducting deductions in section 35AD, 10AA and chapter 6 edits. So calculate your total income, taxable income as per the normal provisions. On that, you apply the normal tax rate, calculate the basic tax, calculate the surcharge if applicable, add health and education cess at 4%. Once you do that, you will arrive at the amount of tax as per normal provision. You will arrive at the amount of tax as per normal provision. Then number 2, this is tax as per AMT provisions, alternate minimum tax mechanism, which is developed. As per that, tax will be calculated as mentioned in point number 2. You have to first of all calculate the adjusted total income. For calculating tax as per the AMT provisions, first of all you have to calculate adjusted total income. Now the question is, how do you calculate the adjusted total income? That is what is explained in this point number A. Important point to be noted: adjusted total income means what? How to calculate? So you already might be having the total income as per the normal provisions, because on that only you have calculated tax in point number 1. Na? In point number 1, you have calculated tax on that total income as per the normal provision of the Income Tax Act. You take that total income, to that amount of total income, you add back chapter 6 deductions which are claimed in section 80 IE, IB, IC, ID, IE, 80 JJAA, QQB, RRB, 80 IAB, etc. All these deductions, whichever are claimed by you, should be added back. Should be added back. Section 10 AA deduction, if you have claimed, add that also. If you have claimed section 35 AD deduction, whatever deduction you have claimed, add back. So first of all, you take total income as per the normal provision. To that you add these 3 deductions. Thereafter you will arrive at certain amount. From that amount, you deduct depreciation in connection with those assets which are acquired for specified business and for which deduction is already claimed. For example, you have acquired asset for 100 in relation to a specified business. That entire 100 you might have claimed the deduction while computing your total income as per the normal provisions. So that 100 we are adding back here in point number 3. That 100 is getting added back here in point number 3. And now you do one thing. On that 100, what is the tax? What is the depreciation rate? Say for example, depreciation rate is 15%. Then on that 100, you calculate 15%. That is 15. You deduct that 15 here. In other words, if you would not have acquired the asset for specified business, then also on 100 you would have claimed depreciation deduction. Then also anyway you might have claimed depreciation deduction. Now how much? 1,515. But since you acquired this asset for specified business, we gave you deduction of entire 100 in the first year itself. So how much effective deduction is available to you? How much extra deduction is available to 85? So net effect is you are adding back 85. What is net effect? You are adding back 85. Have you understood this? Yes or no? Yes or no? Rizwan, have you understood this point number 1? First tell me, have you all understood this point number 1? Okay. Point number 1 is tax liability as per normal provision. So for point number 1, you have to calculate the normal total income. When we say normal total income, it is after claiming deduction for all sections. After 10AA, after 35AD, after chapter 6 deduction, everything. You calculate the total income as per normal provision. On that, you calculate the tax liability as per the normal provision. That will be the amount of tax which is payable as per point number 1. Point number 2, we are trying to ascertain the amount of tax liability as per the alternate mechanism developed by the government for calculating tax. Alternate mechanism is applicable only in case of any person other than company. It is applicable only in case of those SSCs who are claiming deduction under Chapter 6A, which deduction income-based deduction, or they have claimed deduction under Section 10AA or 35AD. Only in their case, this alternate mechanism will be applicable. For calculating the tax liability as per the alternate mechanism, first of all, the starting point is tax as per normal provision only. Starting point is tax as per normal provision only. Sorry, not tax as per normal provision. Starting point is total income. Total income as per the normal provision. On that total income itself, we have calculated point number 1 now. So that same total income is the starting point here. To that total income which is calculated as per the normal provision, you add back 3 things. Whatever deduction you have claimed in Section 10AA, that amount of deduction should be added back. Whatever deduction you have claimed in Section 35AD, you add back that amount. Whatever deduction you claimed in Chapter 6A, income-based deduction, in Section 80 IEA series, that also you add back. Thereafter, the amount which is arrived will be called as income before deduction. This is called as income before deduction. From that, you deduct a depreciation as per Section 32 on the value of those assets which were acquired for 35AD. I gave you an example that you acquired an asset worth 100 for a specified business mentioned in Section 35AD. So while calculating your normal total income, you might have already claimed deduction for that 100 in Section 35AD. You might have already claimed deduction for that 100. Yes or no? Rizwan? If you have acquired asset worth 100, then while calculating your total income, you might have definitely claimed the deduction for that 100 in Section 35AD. Now what we are doing, we are adding back that 100 deduction. In point number 3, we are adding back the deduction. Now my question to you is, if that asset would not have been acquired for specified business, if it would have been acquired for some other business, then you would not have claimed deduction for the entire cost of asset. Na? In that case, what would have been allowed to is only depreciation. How much? 15% of 100, say 15. So, if you have not acquired the asset for specified business, then also you would have claimed 15 deduction. But you acquired the asset for specified business and you claim deduction for entire 100. So, if you try to see the net effect, you have claimed how much deduction? 85. 85 extra deduction you have claimed because of Section 35AD. That 85 we are adding back. 85 is the net effect of this amount and this amount. Here you have to add back 100. Here you have to deduct 15. So net effect in this calculation will be 85. Yes, Rizwan, have you understood this? Yes. So what we are trying to understand? We are trying to understand how to calculate the tax liability as per the alternative mechanism developed by the government. For that purpose, you have to calculate adjusted total income. For that purpose, you have to calculate what? Adjusted total income. And this is the format for calculating your adjusted total income. Starting point of this will be total income as per the normal provision. In that, we will add back Chapter 6 deduction claimed under Section 80 IE, IB, IC, IAB, ID, IE, double J, double A, QQB, RRB. If you have claimed 10 double A deduction, that will be added back. If you have claimed Section 35 ID deduction, that will be added back. And you will arrive at certain amount. From that, you have to calculate depreciation on the value of that asset for which you already claimed deduction in Section 35 ID. The asset for which entire cost is given to you as deduction in Section 35 ID, on the value of that asset, you calculate depreciation. And then you deduct the depreciation here. The amount which is arrived will be called as adjusted total income. Amount which is arrived will be called as what? Adjusted total income. Now, you have to see this amount. If this adjusted total income amount is less than or equal to 20 lakhs, if this adjusted total income amount is how much? Less than or equal to 20 lakhs, then in that case, government says you are a very small SSE, your adjusted total income is only 20 lakhs. In that case, we will not apply this alternate mechanism of calculation of tax to you. We will not apply the alternate mechanism for calculation of tax to you. In other words, this alternate mechanism for calculating the tax liability will be made applicable to you when your adjusted total income is more than 20 lakhs. When your adjusted total income is more than 20 lakhs. If your adjusted total income is less than equal to 20 lakhs, then you forget about this. This chapter is not applicable to you. Whatever income tax you have calculated as per the normal provision, you pay the tax to the government. That's all. So you calculate this adjusted total income. If this adjusted total income is less than equal to 20 lakhs, then forget about this chapter. This chapter is not applicable to you. You are a very small SSE. Government says you pay tax as per the normal provisions only. This chapter is not applicable to you. But if the adjusted total income is more than 20 lakhs, then yes, this chapter is applicable to you. In that case, what you have to do? On this adjusted total income, you apply 18.5%. On this adjusted total income, you apply how much? 18.5%. So here in point number 2, you will write at 18.5% of adjusted total income. 18.5% of your adjusted total income. Basically, this 18.5 is nothing but tax rate as per the alternate methodology. Tax rate to be applied in case of alternate mechanism is 18.5%. Whatever this basic tax is arrived, to that you add surcharge if surcharge is applicable. To that you add health and education cess as at the rate of 4%. You add health and education cess as per at the rate of 4%. Then after whatever amount is arrived is called as alternate minimum tax. That is called as what? That is called as alternate minimum tax. Then how much amount you have to pay to the government? Amount calculated as per regular income, regular provisions, or amount calculated as per the AMT? What you have to actually pay to the government is higher of the following two. You have to actually pay higher of the following two to the government. Yes, have you understood this? Yes or no? Yes, okay. Now listen to me carefully. What is the tax rate applicable in case of those SSEs who are liable to alternate minimum tax provisions? 18.5% of adjusted total income. Yes, yes. If your adjusted total income is less than or equal to 20 lakhs, then AMT provisions will not apply. Then no AMT. Sarvana, is that clear? Okay. Only if this adjusted total income is more than 20 lakhs, your AMT provision will apply. If AMT provisions are applicable, then you take this adjusted total income. On that, you apply 18.5 percentage. That will become your basic tax. On that, if you add surcharge, if applicable, and also add 4% health and education cess. But very important point to be noted is, if the SSE is a unit located in International Financial Service Center, I told you now, government had an intention of making India as a financial hub. Right now, Singapore is a financial hub for the entire world. Government had an intention of making a financial hub in India. So government was having intention to set up International Financial Services Center. In that International Financial Service Center, lot of entities will be situated. Stock exchange will also be situated. You can purchase, sell shares in foreign currency there. Till now, in India, they have not started any International Financial Service Center. The first International Financial Service Center is going to come up in the state of Gujarat. So, if SSE is a unit located in International Financial Service Center and is deriving his income solely in a convertible foreign exchange, in that case, the AMT tax rate will not be 18.5 percentage, it will be 9 percentage. Instead of 18.5 percentage, it will be 9 percentage. So if SSE is a unit located in International Financial Service Center and they are doing transaction in a foreign currency only, then here instead of 18.5 percentage, you have to apply 9 percentage. Budget amendment is inserted in 2020, applicable with effect from assessment at 21-22, which says that SSE has to take a report from a chartered accountant in form number 29C. SSE has to take a report from a chartered accountant in form number 29C. In that form number 29C, your tax liability calculation will be there. So CA will do the calculation, CA will give you the report, and that report is required to be furnished to the income tax department 1 month prior to the due date of filing return. 1 month prior to the due date of filing return, that report is required to be submitted to the income tax department. Last year, this report was required to be submitted along with filing income tax return. Along with filing income tax return, this report was required to be submitted. Now this report is required to be submitted 1 month prior to the filing return. 1 month prior to the due date of filing return, this report is required to be submitted to the income tax department. I have shown you which tax you have to pay to the government. You have to pay regular income tax or you have to pay AMT. What amount you have to pay to the government? Yes? Which amount you have to pay to the government? You have to pay regular income tax to the government or you have to pay AMT to the government? Answer is you have to pay whichever is higher. You have to pay whichever is higher. So, you have to pay whichever is higher to the government. If at all higher is AMT, if at all higher is point number 2, that is tax payable as per AMT, then we will give you AMT credit. Then we will give you AMT credit. Such AMT credit can be carried forwarded for how many years? It can be carried forwarded for 15 years. It can be carried forwarded for 15 years, and in future, this AMT credit can be adjusted. In future, this AMT credit can be adjusted. Adjusted against what? Adjusted against regular income tax or adjusted against regular income tax minus AMT? Yes? In future, it will be adjusted against regular income tax minus AMT. In future, it will be adjusted against regular income tax minus AMT. So let us quickly read this point number 2. AMT credit to be allowed to be carried forward for 15 years and set off allowed against excess regular tax over the AMT. Excess of AMT paid over and above the regular income tax payable shall be allowed to be carried forward, which can be carried forward to the next 15 assessment years from the end of the financial year in which the credit has arisen, and this can be set off against regular income tax payable over and above the AMT in those 15 consecutive years. Important point to be noted: AMT credit, if it is not availed of in 15 years, it shall lapse. If you are unable to claim the AMT credit in the next 15 years, then it will lapse. No interest will be given to the assessee on that AMT credit amount. AMT credit, no interest will be paid to the assessee. Point number 3 says, if income tax department has taken up your case for scrutiny and some changes have occurred in your income, your returned income is 10 lakhs. Your returned income is say 30 lakhs and your assessed income is 40 lakhs. Your return income is 30 lakhs and your assessed income is 40 lakhs. Then definitely your regular tax payable amount changes. So your AMT will also undergo changes. If AMT changes, your AMT credit will also change. So if department has done the assessment and the income assessed by the department is different as compared to what you had declared in your income tax return, then tax liability as per regular income tax payable, tax liability as per the regular provisions, normal provisions will be more. That amount will change, as a result of which your AMT credit amount will also change. So if there is a change in the regular income tax or AMT, your AMT credit will change. Accordingly, you have to change the amount of AMT credit. Point D says AMT credit can be set off only in the year in which regular tax payable exceeds AMT. And it can be set off only to the extent. First of all, it can be set off in the year in which regular income tax payable is more than AMT. And second, it can be set off only to the extent regular tax is excess as compared to AMT. Only to the extent regular tax payable is in excess as compared to AMT. So this AMT credit is claimed against what? AMT credit is not claimed against the regular income tax payable. It is claimed against regular income tax payable minus the AMT. All other provisions of Income Tax Act would apply in the normal manner. Dikshit, in our example, in year number 3, you can set off the AMT credit to the extent of 10. You can set off the AMT credit to the extent of 10. Because 10 is the excess tax as per normal provision as compared to AMT. In year number 3, your AMT is 90 and your regular tax is 100. So how much you have to pay to the government? Actually, 100 is payable to the government. But to the extent your regular tax is more than AMT, to that extent we will allow you to set off. Set off what? AMT credit. So to the extent of 10, we will allow you to set off the AMT credit. So you adjusted 10. So balance amount you have to pay to the government, that is 90. Is that clear? Yes or no? Yes, okay. Point number 4 says what? Applicability of AMT provisions. Applicability of AMT provisions. Provisions of this chapter will apply to whom? Provision of this chapter will apply to individual HUF, AOP, BOI, artificial juridical person, provided they have claimed deduction under chapter 6A, they have claimed deduction under section 10AA or deduction under section 35ED. AMT provision will apply only if the adjusted total income is more than 20 lakhs. In other words, AMT provision will not apply if the adjusted total income is less than or equal to 20 lakhs. If the adjusted total income amount is less than or equal to 20 lakhs, then AMT provision will not apply. Credit of AMT, sorry, sorry. Credit of AMT is allowed as per section 115 JD. Credit is allowed means you can carry forward the extra tax paid as per AMT. Carry forward for how many years? 15 years. And in those consecutive next 15 years, you can set up the AMT credit against what? Regular income tax minus the AMT. Now we have definition. What do you mean by accountant? I told you now you have to take report from a chart accountant. So what do you mean by accountant? What do you mean by alternate minimum tax? What do you mean by regular tax? These things are defined. And here I have AMT provisions at a glance. The entire AMT provisions, they are summarized here in these 9 points. AMT provision is covered by chapter 12BA of the Income Tax Act. Relevant sections are section 115 JC, JD, JE, JEE and JF. These provisions are applicable to all persons other than company. These provisions are applicable to all persons other than company. AMT provisions are applicable to firm. Ideally, it should be applicable to firm. It should be for every person other than company. But here I have written only individual HUF, AOP, BOI and artificial juridical person. See, local authority anyway, income of local authority is exempt from tax. Income of local authority is exempt from tax. But yes, AMT provision will also be applicable to firm. If AMT provisions are applicable to you, then tax payable is higher of regular income tax payable on the total income, or 18.5% is of adjusted total income. Whichever is higher is payable to the government. SSA has to submit CA report in form number 29C. AMT credit equals to AMT minus regular tax payable. AMT credit can be carried forward for 15 consecutive years. This AMT credit can be set off against excess of regular tax payable over AMT in the subsequent year. Starting point of adjusted total income calculation is net taxable income as per the normal provisions. Today before exam, you can refer this from this 9 point from that is sufficient. So we have a practical question on AMT. Dixit is asking me question. Sir, if SSC has claimed a deduction under section 80 QQB, whether the AMT provisions are applicable to him? Answer is yes, they are applicable. They are applicable. If SSC has claimed deduction in section 80 TTA, 80 TTB, then not applicable. AMT provisions are applicable if SSC has claimed deduction in section 80 IA, IAB, IB, IC, ID, IE, 80 JJAA, QQB or RB TTA. Sorry, QQB and RRB. If SSC has claimed deduction in these sections, then yes, AMT provisions are applicable. Is that very clear, Dixit? Yes, shall we proceed? Now see, the solution is given here. We should not look at the solution. We should do the oral calculation. You might be having the rough book in front of you. You might be having the notebook. You might be having the calculator. So we'll just read this entire question and we'll try to solve. Yes, Sarvana, I told you earlier also. If SSC has not claimed any deduction in 35AD, he has not claimed any deduction in section 10AA, he has not claimed any deduction in this 80 series, then AMT provisions are not applicable. Why government came out with this alternate minimum mechanism? Because Due to deductions, income was falling drastically and tax liability was falling drastically. Government's tax collection was getting affected badly. That is the reason government came out with an amendment to ensure that their tax collection is consistent. Dikshit, yes, all these conditions are cumulative in nature. All these conditions are cumulative in nature. Deva madam is asking me, can SSC claim deduction under any other section? Yes. Any other section like section 80C, 80 triple C, 80D, double D, 80U, yes, 80E, 80 double E, 80 EEA, 80 EEB, 80G, 80 double G, 80 GGA, GGB, GGC, all these deductions can be claimed. All these deductions can be claimed. AMT would not apply in that case. AMT would be applicable only if you are claiming deduction in section 35D, section 10AA, or section 80IA series. 80I series, including 80JJAA, QQB, RRB. Yes, shall we proceed further? Let us refer to this practical question. Question number 1 says, PQR LLP is a limited liability partnership set up in a special economic zone in the financial year 1670. So if you are set up in a special economic zone, you enjoy a tax holiday for 15 years. For the first 5 years, 100% of profit. So this is set up in the year 1617. So 16, 17, 17, 18, 18, 19, 19, 20, 20, 21. 2021 is 5th year. So 100% reduction will be allowed in respect of profits earned from an export turnover of SEZ unit. Yes or no? Have you understood this? Yes. So they have set up a factory in special economic zone for manufacturing washing machines. The unit fulfills all the conditions of section 10AA of the Income Tax Act 1961. During the financial year 1920, it has also set up a warehousing facility in the district of Tamil Nadu for storage of agriculture produce. See, if you set up a warehousing facility for storage of agriculture produce, you can claim deduction for capital expenditure in section 35AD specified business. You can claim deduction for capital expenditure in section 35AD specified business. Is that very, very clear? So in this case, SSE is claiming deduction in 35AD also. He is claiming deduction in 10AA also. Read this further very quickly. Yes. What it says? Capital expenditure in respect of warehouse amounted to 75 lakhs. Including land cost is 10 lakhs. Including land cost is 10 lakhs. You know, na, section 35AD, you cannot claim deduction for cost of land. You can claim deduction only for any capital expenditure except land, goodwill, and financial instrument. Do you remember that? Yes or no? The warehouse became operational with effect from 1st April 20, and the expenditure of 75 lakhs was capitalized in the books of accounts on that date. Any pre-commencement expenditure incurred for specified business. If you have incurred any pre-commencement expenditure, if pre-commencement expenditure is incurred for specified business, deduction is allowed in the year in which business is commenced. How much deduction will be allowed to in section 35AD? In this case, In this case, how much deduction will be allowed to you in section 35 ID? 65 lakhs. 65 lakhs. Relevant details for the financial year 2021 are as follows. Profit of a unit located in SEZ is 40 lakhs. Export sales of SEZ unit is 80 lakhs. Domestic sales of SEZ unit is 20 lakhs. Profit from operation of warehousing facility before deduction under section 35 AD is 1 crore 5 lakhs. Compute the income tax including AMT under section 115 JC payable by PQR LLP for the assessment at 21-22. You forget about this. First of all, you tell me what is the profit from a specified business? Profit from specified business before claiming deduction is 1 crore 5 lakhs, correct? From this 105 lakhs, how much deduction will be allowed to in section 35 ID? 65 lakhs, correct? So what is the income then? What is the amount of income after deduction? Income after deduction will be how much? 40 lakhs. Income after deduction will be 40 lakhs from the business of warehousing facility. From the business of warehousing facility, income after deduction will be 40 lakhs. Have you all understood this? Yes. Okay. Now you tell me what is the profit of unit located in SEZ? 40 lakhs. What is the export turnover? 80 lakhs. What is the domestic turnover? 20 lakhs. Can you tell me out of 40 lakh what will be the proportionate profit of export turnover? 32 lakhs. Yes or no? That 32 lakhs will be allowed to as deduction in this section. Section 10 AA. Section 10 AA, you will get deduction for that 32 lakhs. Correct or not? So what will be the profit of that SEZ unit after deduction? After deduction, what will be the profit of that SEZ unit? 8 lakhs. 8 lakhs. Yes or no? So that 8 lakhs will be forming part of your taxable income from SEZ unit. From warehousing facility, your taxable income is 40 lakhs. So what is the total income as per normal provision? Total income as per normal provision is how much? Yes. Total income as per normal provision is 48 lakhs. Yes or no? Total income as per normal provision will be 48 lakhs. See this. Profits and gains of business or profession. Profit from unit in SEZ, 40 lakhs. From that, how much is allowed as deduction in section 10 AA? Proportionate profit 32 lakhs. 32 lakhs. For calculating that 32 lakhs, they have made this working note number 1. They have just done the cross multiplication and ascertained the proportionate amount. 40 lakhs is the profit of SEZ unit. Multiply by export turnover divided by total turnover. 32 lakhs is deduction under section 10 AA. So out of 40 lakhs, 32 lakhs is deduction under section 10 AA. Balance is 8 lakhs. Out of warehousing facility, your profit is 105 lakhs. Deduction under section 35 AD is 65 lakhs. Balance taxable income is 40 lakhs. Total is 48 lakhs. Total is 48 lakhs. Now we calculate tax on this 48 lakh. SS is a LLP, na LLP form. The tax rate is flat rate 30%. So on 48 lakh, 30% tax will be how much? 14 lakh 40,000. 14 lakh 40,000. Whether surcharge is applicable? No, it is not applicable. Surcharge is not applicable. Then you calculate 4% health and education cess. 4% health and education cess on 14 lakh 40 is 57,600. So tax liability is 14 lakh 97,600. This 14 lakh 97,600 is tax liability as per which provision? This as per the normal provision. 14,97,600 is tax liability as per normal provision. Now you know that SSE is a LLP, SSE is a firm. SSE has claim deduction section 10AA also, 35AD also. So AMT provisions are applicable to SSE. AMT provisions are applicable. So we need to proceed with the calculation of adjusted total income. Can you tell me what is the starting point of calculation of adjusted total income? Starting point is tax total income as per normal provision. What is total income as per normal provision? 48 lakhs. 48 lakhs. Sarvana, not regular income tax. Regular income. Starting point is not the tax liability. Starting point is income. That is 48 lakhs. To this 48 lakh, I will add back what? I will add back 10AA deduction. I will add back 10AA deduction. I will add back 35AD deduction. So 10AA 32 lakhs I will add back. Section 35AD 65 lakhs I will add back. So what amount will be arrived? 48 lakhs plus 32 lakhs plus 65 lakhs. Will be how much? 145 lakhs. Yes or no? Yes. 145 lakhs. What is this 145 lakhs? Yes. What is this 145? This 145 lakhs is called as adjusted total income. This 145 lakhs is called as what? It is called as adjusted total income. Do you believe that this is more than 20 lakhs? Definitely yes. So you calculate tax liability as per the AMT provision. On this 145 lakh, you will apply what rate of tax? 18.5%. 18.5%. You apply 18.5% on 145 lakhs. How much amount is derived? 18.5% of 145 lakhs will be how much? Oh yes, you have to claim depreciation also. From that you have to deduct depreciation also. One second. 75 lakh is the capital expenditure incurred for warehouse. From that 10 lakh is land cost. So that you should forget. So what is the balance? Balance is 65 lakhs. 65 lakhs is the cost of building. And on building depreciation rate is what? Generally building, what is depreciation rate? 10%. So that would be 6.5 lakhs. Yes. So you should deduct 6.5 lakhs from what? From 145 lakhs. From 145 lakhs, you should deduct 6.5 lakhs. That will be how much? 138.5 lakhs. 138.5 lakhs. Yes or no? Yes. Everyone have understood this? So our starting point will be total income as per normal provision, which is 48 lakhs. To that we will add back 10AA deduction, 32 lakhs. To that we will add back 65 lakhs deduction under section 35D. From that I will deduct depreciation on the value of building, that is 10% of 65 lakhs, 6.5 lakhs. So net effect is 58.5 lakhs will be added. So my adjusted total income is 1 crore 38 lakhs 50,000. 1 crore 38 lakh 50,000. This is definitely more than 20 lakhs. Adjusted total income is more than 20 lakhs. So on this you have to apply 18.5%. So if you apply 18.5% on 1 crore 38 lakh 50,000, what is the amount derived? 25 lakh 62,250. On that you have to apply surcharge also, because your adjusted total income is more than 1 crore. Your adjusted total income is more than 1 crore, you have to apply surcharge also. So you calculate surcharge at 12% on this. Yes, calculate the surcharge at the rate of 12%. Will be how much? 12% of 25 lakh 62,250. Dikshit, wait for some time. Right now, let us not get into those difficulties of section 80C. First of all, let us complete this solution, and then we'll have a discussion. What if SSC has claimed 80C also? This surcharge amount is correct. So 28 lakh 69,720 is tax plus surcharge. On that, you add 4% health and education cess. 4% health and education cess. What is the amount? 4% health and education cess. $114,789. Okay. Now we add 114,789 to this 28 lakh 69,720. Yes. Are you getting this amount 29 lakh 84,509? This is required to be rounded up to nearest multiple of 10 rupees, na? This is required to be rounded up to the nearest multiple of 10 rupees. So let us round off 29 lakh 84,510. 510. Now you tell me tax as per normal provision is what? 14 lakh 97,600. Tax as per AMT provision is 29 lakh 84,510. So what is payable to the government? 29 lakh 84,510 is payable to the government. Yes. Now you tell me what will be the AMT credit in this case? What will be the AMT credit? AMT credit will be 29 lakh 84,510 minus 14 lakh 97,600. So your AMT credit will be 14 lakh 86,910. 14 lakh 86,910 will be the AMT credit. This AMT credit will be carried forwarded for 15 succeeding assessment years. This will be carried forwarded for 15 succeeding assessment years. Is that very clear? Yes? Okay. Now Dikshit was asking me, sir, if SSC has also claimed a section 80C deduction of 1 lakh 50, then what will be the consequence? See, Dikshit, if SSC has also claimed the section 80C deduction here, for example, 80C deduction is 1 lakh 50, then your total income here, it will not be 48 lakhs. It will be how much? 46.5 lakhs. It will be 46.5 lakhs. On that 46.5 lakh, you calculate tax. But Dikshit, very important point to be noted is, Dikshit, very important point to be noted is, 80C deduction is allowed only to individual HUF. Here the question is pertaining to LLP. Partnership from LLP, anyway section 80C deduction is not allowed. But since you asked me the question, presuming that this question is belonging to individual, presuming that this is individual only, then what will be the change in the solution? From 48 lakh, you will deduct 1 lakh 50,000 deduct under section 80C. So your balance total income will be 46.5 lakhs. On that 46.5 lakhs, you have to calculate tax as per slab rates. You have to calculate tax as per slab rates. Whatever tax as per slab rate that you have to calculate, to that you add 4% cess, then you get total tax amount. So this amount will change. And if this is the question of individual, then this AMT amount will remain the same. That AMT amount is going to remain the same. There will not be any change. So AMT will be at 29,84,510 only. But since tax as per normal provision has changed, your AMT credit will definitely change. Your AMT credit will definitely change. Yes, have you understood? So with this, we have completed the AMT provision. Yes, Deva madam. It is not necessary that you pay, if you have claim deduction in 35AD as well as section 10AA, then only AMT provisions are applicable. AMT provisions are applicable if you have claim deduction in 35AD or in section 10AA or chapter 6 deduction in 80 IS series. If you have claimed any of these deductions, AMT provisions will be applicable. Yes, have you understood this very clearly? So this chapter is over. 115 BAC. Extra questions are sent to you. 2 questions are there. You can solve on your own. If you have any difficulty, we will discuss tomorrow. This miscellaneous computation of total income and tax liability chapter is over. At the end, 3-4 past examination questions are given. With solution, you can refer. Now we are left with only one chapter. Which one is that? Return of income and self-assessment. Dikshit, if you are claiming deduction in 80 QQB, anyway AMT provisions are not applicable. Along with 80 QQB, you are claiming deduction 10AA, then it will apply. If you are claiming deduction on only 80 QQB, then anyway AMT provisions are not applicable. Yes. Dikshit, is that clear? Okay. So now we are left with one chapter, return of income and self-assessment, from page number 358 to 369, so around 11 pages. This chapter is around 9 pages. 2 pages are practical questions. 2-3 pages are practical questions. Now, this chapter is full of theory. If you want, I can give you 5-7 minutes break before we start this chapter. Yes? You want a break right now for 5-7 minutes? Yes. Because this is full of theory. Most of the students are saying that yes, we want a break. So we can have a break. 8 minutes break I am giving you. Right now it is 11:07 in my watch. We'll start once again at 11:15. Dikshit, you can ask your doubt right now. We'll start at 11:15. You can ask your doubt right now. Which deductions are not applicable means? What do you mean by which deductions are not applicable? Which deductions can be claimed? In AMT provisions, which deductions can be claimed? Is that the question? Yes, Dikshit? Yes. Which deduction can be claimed? See, all deductions can be claimed. 80C can be claimed, 80CCC can be claimed, 80CCD can be claimed, 80D, 80DD, 80DDB, 80E, 80EE, 80EA, then 80G, 80GG, 80GGA, GGB, GGC, 80TTA, 80TTB, 80U. This can be claimed. If they are claiming deduction in this section only, then this AMT provisions are not applicable. AMT provisions are applicable if you are claiming deduction in 80IA, IAB, IB, IC, ID, IE, JJA, JJA, QQB, RRB. If you are claiming deduction in this section, then only AMT provisions are applicable to you. Dikshit, is that very, very clear? Instead of 9, you can say 10 sections. Along with 80JJA, you can also take 80JJAA, 80JJAA. 80JJA and 80JJAA. They are two different sections. I have taught you 80JJAA. 80JJA is not part of your syllabus. But 9, instead of 9, you can take 10 sections. 80JJAA also. Yes, is that very clear? See, this chapter which we are discussing, generally questions are not asked from this chapter, but whenever there is an amendment, they ask the question from this chapter. Average marks in the examination, average weightage of this chapter in the examination is 2.5 marks. Average weightage of this chapter in the examination is only 2.5 marks. Question will be asked only if there is an amendment. I will teach you entire chapter, but I will give you some important points. You have to refer only those points day before examination. Everything you need not read before the examination date. So first of all, we'll start with section 139, subsection 1. This chapter talks about return of income and self-assessment. See, what do you mean by self-assessment? Self-assessment means once your previous year is over, then the assessment year would arrive. In the assessment year, SSC he himself has to assess his own income and he has to file the income tax return. SSC has to assess his own income and he has to file the income tax return. That income tax return is called as return of income. So SSC will do the self-assessment. He will do the self-assessment means he will ascertain his own income, he will ascertain his tax liability, and he will file his income tax return. So there are two questions here. Question number 1 is it mandatory for everyone to file the income tax return? Is it mandatory for everyone to file the income tax return? And if yes, what is the due date for filing the income tax return? So first of all, we need to understand that is it mandatory for everyone to file the income tax return? So answer to this question is It is not mandatory for everyone to file the income tax return. Government has given certain conditions. If you satisfy those conditions, then it is mandatory for you to file the income tax return. If you don't satisfy the condition, then you need not file the income tax return. If at all it is mandatory for you to file the income tax return, then what is the due date for filing income tax return? That is also we need to understand. That also we need to understand. So first of all, we'll try to understand part one. That is it mandatory for everyone to file the income tax return. Then we'll move on to part two. What is the due date for filing the income tax return? Both these things are given in section 139 subsection 1. So point number 1 says, for every company and firm, when we use the word firm, by default it also includes limited liability partnership firm. The word firm by default will always include LLP. So every company or every firm, they are always required to file their income tax return, irrespective of whether they are having positive income, negative income, or zero income. So it is mandatory for every company and firm to file the income tax return, irrespective of their income. Whatever may be their income, it is mandatory to file the income tax return in their case. Have you understood this? Positive income, negative income, zero income will not make any difference. They will have to file the income tax return mandatory. What about other persons? Other person means other persons means other than company and firm. Other persons means other than company or firm. In case of individual, HUF, association of person, body of individual, it is mandatory to file the income tax return. Individual, HUF, association of person, body of individual, and artificial juridical person. For these four persons, it is mandatory to file the income tax return, provided their total income before claiming exemption in section 1038, before claiming 10A, 10B, 10BA deduction, before claiming chapter 6 deduction, and before claiming any exemption in section 54 series in the chapter of capital gain. If their income before claiming deduction and exemption exceeds basic exemption limit, then it is mandatory for them to file the income tax return. See, if your income exceeds basic exemption limit, you have to file the income tax return. But we are not talking about the taxable income. We are talking about the income before claiming deduction and exemption under this section. Taxable income is after claiming deduction and exemption. We are talking about income before claiming deduction. So whatever is the taxable income, to that taxable income, you add back chapter 6 deduction, you add back section 54 series exemption, if at all you have claimed, you add back 1038, 10A, 10B, 10BA deduction. After adding everything, the amount of income which is arrived will be called as income before certain exemption and deduction. If that income before certain exemption and deduction is more than the basic exemption limit, then it is mandatory for the individual HUF, VFBY, and artificial juridical person to file the income tax return. Have you understood this very clearly? Yes? See, in that alternate minimum tax, we calculated adjusted total income. So starting point was total income as per the normal provision. To that we added 10 AA, 35, 80, 80 IS series, etc. And the amount which is derived was called as adjusted total income. Similarly, here also we have to take the total income, and to that we have to add back 1038, 10A, 10B, 10BA, chapter 6 and section 54 exemption. You add back this amount, the amount which is derived will be called as income before deduction and exemption. If that income before deduction and exemption is more than the basic exemption limit, 2.5 lakhs, 3 lakhs, 5 lakhs, whichever is applicable. In that case, it is mandatory for the assessor to file the income tax return. Point number 1, point number 2 is over. Now point number 3. Point number 3 is very important. Listen to me carefully. Rizwan is asking me what is this 3 section 54 GA. Here by mistake I have written 54 GA or G. It should be GB. First of all, there is a typing error here. 54G, 54GA or 54GB. This section 54G, GA, GB, that is not forming part of your syllabus at intermediate level. That is not forming part of your syllabus at intermediate level. In the chapter of capital gain, we have discussed 54, 54B, 54D, 54EC and 54F. There are 3 more sections for exemption, 54G, GA and GB. Those were not forming part of your syllabus, therefore we have not discussed. But here, it is not G, it is GB. So we have completed 2 points. Now listen to me very carefully. Do you remember before 2014, before this NDA Modi government was formed, Anna Hazare, Arvind Kejriwal, Baba Ramdev, and there were a lot of other people also. All these people sat on a dharna saying that government is not proper. There is huge amount of black money outside India. Government is not interested in growing the economy. They are not acting on black money. Such kind of allegations were made by these people. Anna Hazare, Arvind Kejriwal, Baba Ramdev, all these people had made the allegations, saying that people in India, they are not paying taxes. They are transferring their funds from India to outside India through Hawala, and they are acquiring properties worth lakhs and crores of rupees outside India. So there is huge amount of black money lying outside India. Government of India should take some strict action to bring that black money in India. If entire black money comes back to India, Indian economy will have heavy investment, and economy will grow like anything. That is what these people used to claim. But if you ask them the question, where is that black money lying? They'll say that that black money is lying outside India. But where outside India, no one knows. So because of all this dharna pradarshan, etc., government came out with an amendment in the Income Tax Act, and these 2 points were inserted. So these 2 points were inserted around 2013, 2012 or 2013. It says, if a person is resident and ordinary resident, who can be resident and ordinary resident? Only an individual or HUF can be resident or ordinary resident. So, if a person is resident and ordinary resident, and he is not required to file his income tax return as per the above provision. So, in other words, they are trying to tell you that if their income before deduction and exemption does not exceed basic exemption limit. If the income before claiming deduction and exemption is exceeding basic exemption limit, then definitely they will be required to file the income tax return as per point number 2 only. But we are saying that if your income before exemption and deduction is not exceeding the basic exemption limit, then you are not required to file the income tax return. But if you are ordinarily resident and you are having any asset located outside India, if you are having any asset located outside India, or you have opened any bank account outside India in which you are a signing authority, or you are having a financial interest in any entity situated outside India. Having financial interest in any entity situated outside India means you might be a shareholder in that entity. So there are three situations. Number one, you are having any asset situated outside India. Number two, you are having a bank account outside India in which you are having a signing authority. And number three, you are having a financial interest in any entity situated outside India. In that case, it is mandatory to file your income tax return irrespective of your income. Whatever may be your income can be more than the basic exemption limit, less than the basic exemption limit, it can be zero, it can be anything. It is mandatory for you to file the income tax return. Even if your income is zero, you have to file the income tax return. So, if you are not covered by point number 2, then point number 3 can catch you, provided you are having an asset situated outside India, you are having a bank account outside India, or you are having a financial interest in any entity situated outside India. Have you understood this? Yes? So, this was point number 3.1. This is applicable in case of which assessing? Which persons? Those who are not covered by point number 2 and they are resident and ordinarily resident. Who can be resident and ordinary resident? Only individual achievers. Basically, this point was inserted only for individual, but they are not actually writing the word. So individual achiever both can be covered because both can be resident and ordinary resident. Second point says what? Second point I will read. Thereafter, if you don't understand, I'll give you example. Second point says if such person is a beneficiary of any asset located outside India, then he has to file the return. For example, Sarvana has purchased property worth 5 crore outside India. Sarvana has purchased property worth 5 crore outside India. But this property is held in the name of Sarvana's child, or this property is held in the name of Sarvana's wife. So legally, as per the agreement, Sarvana's wife is owner of the property. But funds belonging to Sarvana were used now. So Sarvana will be called as a beneficial owner. Sarvana's wife will be called as a legal owner. Sarvana will be called as a beneficial owner. And income from that property, whatever income is generated from that property now, it is used for the benefit of Sarvana's child. So Sarvana's child will be called as a beneficiary. Sarvana's child will be called as beneficiary. Beneficiary means a person for whose benefit this asset is acquired. Beneficiary is a person for whose benefit this asset is acquired. So if a person is not covered by point number 2 or point number 1, basically we should not say 1, only 2. If a person is not covered by point number 2, and if he is resident and ordinary resident in India, and that person is a beneficiary of any asset or financial interest in any entity located outside India. Do you understand a beneficiary? Have you understood the word beneficiary, or do you want me to give an example to you? Yes. Example. Uh, for example, Sarvana has achieved the age of, he has completed 70 years of age. He has completed 70 years of age. Now he says that whatever I wanted to achieve in my life, I have achieved everything. I am totally satisfied with my life. So even if God arrives at my door to take me away from this world, I am ready to go right now only. But Sarvana says, before I die now, I need to settle my obligations. I need to transfer my property to someone. So after my death, my children should not fight with each other. So what Sarvana has done now? Sarvana has created one trust. Sarvana has created one trust. Trust can be created by making a trust deed. So Sarvana has made a trust deed. So trust is created. Sarvana has transferred all his properties to the trust. Sarvana has appointed me as a trustee of the trust. Sarvana has created the trust. So Sarvana is a founder of the trust. Sarvana is called as founder of the trust or a settler. Sarvana has appointed me as a trustee. My job is to look after the property of the trust. I am a caretaker. So I am a trustee of the trust. Sarvana has transferred all his properties to the trust. And in that trust deed, it is written, whatever income is generated from the property of the trust, whatever income is generated from the property of the trust should be distributed equally between all my children and wife. So, for example, Sarvana dies. After the death of Sarvana, all this property now belongs to a trust. Whatever income is generated from that property now, it is the job of a trustee to ensure that this income is distributed to the people for whose benefit the trust was created. For whose benefit trust was created in our example is Sarvana's children and wife. So Sarvana's children and wife, they are called as beneficiary. Beneficiary means the person for whose benefit the trust was created. Similarly here, beneficiary means what? Beneficiary means the person for whose benefit the asset was acquired. For example, Sarvana has kept a FD of 1 lakh US dollars. Sarvana has kept a fixed deposit of 1 lakh US dollars in a bank account in USA. And Sarvana has said that interest on this FD should be transferred to my child. Interest on this FD you should transfer to the bank account of my child. In that case, we say that Sarvana's child is a beneficiary of any asset located outside India. See, Sarvana is the owner of the asset located outside India. Sarvana is covered by point number 1 only. If a person is holding a asset located outside India, so Sarvana is covered by point number 1. but the asset was acquired outside India for the benefit of his child. Asset was acquired outside India for the benefit of child of Sarvana. In that case, Sarvana's child will be called as a beneficiary of asset located outside India. Have you understood this? Yes or no? I gave you two examples. One example I gave you of trust, wherein a trust was created by Sarvana and Sarvana has transferred all the property to the trust. And in the trust deed, he has clearly written that whatever income is generated from the property of the trust should be used for the benefit of my children and wife. In that case, children and wife will be considered as beneficial. Similarly, Sarvana has invested money in fixed deposit in USA. He has kept a FD of say 1 lakh or 1 million US dollars. In that case, whatever interest income is generated on that FD, Sarvana has given instruction to the bank that this interest should be given to my child. They should transfer this interest to my child's bank account. In that case, Sarvana is not beneficiary. Sarvana is a owner. Sarvana is a beneficial owner, and Sarvana's child is a beneficial. Sarvana's child also has to file the income tax return because he is a beneficiary of any asset located outside India, or he is the beneficiary in respect of any financial interest located outside India. Have you understood this very clearly? So in our example, Sarvana is the beneficial owner and Sarvana's child is a beneficiary. Sarvana is a beneficial owner, Sarvana's child is a beneficiary. Whether Sarvana has to file the income tax return? Yes, because he is holding property outside India. Yes, if he is holding property outside India, he has to file the income tax return irrespective of his income. Whether beneficiary, that is Sarvana's child, has to file the income tax return? Yes, because he is the beneficiary of the asset situated outside India. Point number 2 further says that if an individual being a beneficiary, he will not be required to file his income tax return if the income arising from the property situated outside India is already taxable in the hands of beneficial owner. If income arising from a property situated outside India, that income is already taxable in the hands of beneficial owner. Who is beneficial owner? Sarvana is beneficial owner. If the income from that FD, which is kept in dollars in a bank outside India, if that FD interest is taxable in the hands of Sarvana, then Sarvana's child being a beneficial owner would not be required to file the income tax return. Because anyway income is already taxed to Sarvana only. So then beneficiary need not file the income tax return. But yes, if the income from that FD is not taxed in the hands of Sarvana, then this income on FD kept outside India should be added to the income of Sarvana's son, and Sarvana's son will be required to file the income tax return. Have you understood this? So point number 3 says what? Point number 3 says, if you are not required to file the income tax return in point number 2, and if you are an ordinary and if you are resident and ordinary resident, then you will have to file the income tax return if you are holding any asset outside India, or you are having a financial interest in any entity situated outside India. Okay, my audio is clear or not clear? Is that very clear? Venkat, I think you are having some problem from your end. You can disconnect and once again connect. Or maybe there is some problem in your headphone, etc. Okay. I'm repeating this point number 3 for you. Point number 3 says, if you are not required to file the income tax return as per point number 2, but you are resident and ordinary resident in India, and you are having assets situated outside India, you are owning assets situated outside India, you are having a bank account outside India, or you are having a financial interest in any entity situated outside India, then you have to file the income tax return in India. Irrespective of your income, you have to file the income tax return in India. The asset which is situated outside India, either you are a legal owner or you are a beneficial owner, you have to file the income tax return in India. Besides, second part says that you are not holding asset outside India. Asset is purchased by someone else outside India, but you are beneficiary of that asset outside India. You are beneficiary means whatever income is generated from that asset will be used for your benefit. In that case, you are beneficiary of the asset situated outside India, or you are beneficiary for a financial interest in any entity situated outside India, or you are a beneficiary for any bank account situated outside India. In that case, you will be required to file the income tax return. Further, it says, however, if the income from the asset situated outside India is already taxed in the hands of beneficial owner, then once again it will not be included in the income of beneficiary. Beneficiary need not file the income tax return. So, however, individual being beneficiary would not be required to file the income tax return if the income arising from an asset located outside India is already taxable in the hands of beneficial owner. See, this point number 4 was inserted last year. This was inserted in budget 2019. It says you are not covered by point number 1, you are not covered by point number 2, you are not covered by point number 3. In other words, you are not required to file your income tax return as per point number 1, 2, and 3. And you are a person other than company or firm. Madam, if the legal owner and beneficial owner are same, then return of income will be filed by that same person. If the legal owner, beneficial owner are different, then what? Then both have to file the return, because here they are using the word as beneficial owner or otherwise. If you are holding the asset outside India, either as beneficial owner or otherwise, or other one means as legal owner. Yes, is that very clear? Okay. Now, once again, we move on to point number 4. Point number 4 says what? You are not covered by point number 1, you are not covered by point number 2, you are not covered by point number 3. In other words, you are not required to file your income tax return. In that case, if you are a person other than company or firm, if you are a person other than company or firm, and you are not required to file your income tax return as per point number 1, 2, and 3, you are not covered anywhere. In that case, also you will be required to file the income tax return if you have deposited aggregate amount exceeding 1 crore in one or more current account maintained by you. You have deposited money You have deposited an amount or aggregate of amount exceeding 1 crore in one or more current accounts with any bank or cooperative bank. So if you are having a bank account with bank or cooperative bank and you have deposited amount exceeding 1 crore in one or more current accounts combined, then even though you are not covered by point number 1, 2, and 3, you will be required to file the income tax return. You will be required to file the income tax return. If you have deposited money 1 crore or more in one or more current accounts, or you have incurred an expenditure exceeding 2 lakh rupees, you have incurred an expenditure exceeding 2 lakh rupees for yourself or any other person for travel to any foreign country. See, if you have incurred the expenditure of more than 2 lakhs for visiting any foreign country, then government wants to just check. If your income is so less that you are not covered by point number 1, 2, and 3, you are not required to file the income tax return. How can you go outside India for a foreign travel? So if you are going outside India for a foreign travel, government wants you to file the income tax return so that government can verify, do you have that much amount of money also? Do you have that much amount of income that you can afford a foreign travel? That is what government wants to check. Therefore, government says, if you have incurred an amount exceeding 2 lakh rupees for yourself or any other person for travel to any foreign company, then yes, you will have to file the income tax return. Point number C says, you have incurred an expenditure for electricity. Means you have paid a electricity bill of more than 1 lakh in a financial year. So if you are an individual, you are not covered by point number 1, 2, 3. You are not covered by point number 4A, 4B. Still, you will be asked to file the income tax return if your yearly electricity bill, is more than 1 lakh. If your yearly electricity bill is more than 1 lakh, then you should file the income tax return. Is that very, very clear? Yes. Have you understood this? Yes or no? Okay. Only current account. Yes. Only current account. Now we will complete this part today. So our section 130 and subsection 1 will get over. So part 1 we have understood. Now if I ask you, is it mandatory for everyone to file the income tax return? What should be the answer? Yes, it is mandatory provided certain conditions are fulfilled. If those conditions are not fulfilled, then it is not mandatory. Then the person need not file the income tax return. If it is mandatory for a person to file the income tax return, then by which date he is expected to file his income tax return? Is there any due date for filing the income tax return? Answer is yes, there is a due date for filing the income tax return. That due date is also given in section 130 and subsection 1. Due date can be either 30th November of the assessment year, or 31st October of the assessment year, or 31st July of the assessment year. When it is 30th November, if the assessee is required to furnish the CA report in respect of an international transaction. If you have done any international transaction, you have exported the goods or you have imported the goods, etc., means you have done any international transaction. Whenever you enter into an international transaction, you have to submit a separate report to the income tax department with respect to which transaction you have entered internationally. In that case, you have to file the income tax return by 30th November of the assessment year. In your case, due date of filing return will be 30th November. Yes, is that very clear? So if you have entered into any international transaction, if you have entered into any international transaction and you are required to submit report, if you are required to submit chart report from a chart accountant in respect of international transaction, then in your case, due date of filing income tax return will be 30th of November of the assessment date. So the previous year is 2021, assessment year is 21-22. So your income tax return for the previous year 2021 should be filed by 30th November 2021. Next, where the SSE is a company other than covered in point 1. If SSE is not covered by point 1, then only you will come to point 2. In point 2, we are saying that if SSE is a company, see, companies' books of accounts are always required to be audited. No, Sarvana, international transaction means not remittance of money. International transaction means purchasing goods, selling goods, acquiring services, selling services. If you are just remitting money outside India, that doesn't mean that you are entered into international transaction. Say, for example, your brother is outside India. He has gone outside India for education. In that case, if you are remitting money outside India, that doesn't mean that you are entered into an international transaction. What is this international transaction is also defined. There is a separate chapter called as transfer pricing in CA final. In CA final, you have a chapter called as transfer pricing. In that, it will be discussed in detail what they mean by international transaction. But for the time being, you can understand that international transaction is for purchase or sale of goods or services. Purchase and sale of goods or services. Point number 2, 3, 4. Point number 2, point number 3, point number 4. In all these points, due date of filing return up to last year, it was 30th September. Now it is extended by 1 month. Now onwards, it will be 31st October. Now onwards, it will be 31st October. In which case, where the SSE is a company, not covered in point number 1. Where the SSE is a company not covered in point number 1 means they have not entered into any international transaction. Number 2, where SSE is a other than company and their books of accounts are required to be audited as per section 44AB of the Income Tax Act. SSE is a person other than company and their books of accounts are required to be audited as per section 44AB of the Income Tax Act. Or where the SSE is a partner of the partnership firm whose books of accounts are required to be audited. SSE is a partner of the partnership firm whose books of accounts are required to be audited. In these 3 situations, due date of filing in return is 31st October. So there is an amendment here. Earlier it was 30th September, which is now changed to 31st of October. This is first amendment. Second amendment is in this point number 4. Last year, what was appearing where the SSE is a working partner in the partnership firm whose books of accounts are required to be audited. So if the SSE was a working partner, then only he was covered by point number 4. Now they have removed the word working. So whether you are a working partner or non-working partner will not make any difference. If you are a partner in the firm whose books of accounts are required to be audited, then for you, the income tax return filing due date will be 31st of October of the assessment. If you are neither covered by 1 nor covered by point number 2, 3, 4, then in your case, due date of filing return will be 31st July. Then in your case, due date of filing return will be 31st of July. Yes, is that very, very clear? Yes or no? Okay. So today we have started this return of income and self-assessment chapter, and we have completed section 139 subsection 1. Section 139 subsection 1 broadly was divided in 2 parts. It was explaining you 2 things. Number 1, under what circumstances it will be mandatory for you to file the income tax return, and number 2, what is the due date for filing the income tax return in different circumstances. different situations. So we have covered up this section 130 and subsection. Now tomorrow when we meet, we'll start with section 234F, 234, etc. This chapter will get completed in maximum 2.5 to 3 hours tomorrow. I have given you some homework today. 115 BAC, those two practical questions along with solution they are given. You have to refer. And if you want, then after completing this chapter, tomorrow we can discuss that section 115 BAC. Practical questions. If you have referred and if you still have doubts, we will definitely discuss in class after completing this chapter. Is that very clear? Yes. So we'll wind up here. Bye bye everyone.